Hello, everyone, and welcome back to the Dynamic Duo. We are back. We're back when everybody needs us, like Batman. The bat sign is on. Everybody needs us because everything's going down. Jose has lost his glasses in the ocean. He needs new ones. Can't see anything, so he can't even see the redness in his portfolio, which, to be honest, might be a good thing. Jose,
Uh,
it's been a while since we've done this duo stream.
yeah, I know, and like you mentioned, the world needs us. Therapy session is needed right now more than ever. Um, but yeah, I'm pretty excited. I mean, we got two amazing earnings. I think Meta and Microsoft are both going to kill it. So yeah, I mean, we got a lot to discuss, and I'm here for it.
If you guys have questions, let us know in the chat. We will do, of course, when the market closes, whatever comes out first, we'll put it up, but we will listen first to Meta's earnings report call, because that starts before Microsoft. After Meta's, it is Microsoft, so we can do both. We'll, of course, try and go over whatever other reports are coming out today. I think maybe ARM as well is today. Robinhood is today.
I think Qualcomm might be today.
Qualcomm might be today as well. Yeah. So we'll do all of that once it comes out, but then we'll focus more on the Meta earnings call followed by Microsoft. Now, of course, there was the FOMC meeting today. I don't know, at one point stocks were recovering, but it seems like right now we are, well, not really recovering, as they say. This is someone that's falling off the wagon. The stocks went maybe a tiny bit less red, but we're now back in the deep red for all of our favorite AI names, bottleneck names, whatever you want to call them. They're down. NVIDIA is down 3% almost. AMD is down 5%. Micron is now at $744. So, yeah, not that great.
Just turn it off, right? Just turn it off. Turn it off and turn it back.
If I do this, it's better. The performance year to date looks much, much better. But then again, over the last month, there has been a cool off, right? Micron is down 34% over the past month. I think SanDisk is down 50% or so from the highs, which, are you surprised?
Am I surprised? I don't know. Yeah, I think I'm surprised, Neil, that it happened so quickly. And it happens for, am I surprised? I don't know. It's such an interesting question because we had a crazy rally, right? I think in May and June. And everybody was showing off their portfolio, right? Everybody was. So when you get those signs, I'm not too shocked. I'm more shocked of how quickly it's happening and how heavy it's going, right? We have kind of like CoreWeave down in the 60s, some optics names down like 50%, some memory names like you saw down 50%. And I'm all for it. But yeah, I'm just shocked it happened so quickly. I think in like a matter of a month, people were going from like all-time highs to like 3-month low or 4-month low.
Do you, with the memory names, do you think the China news, right, the Chinese companies saying that, oh, we can make memory for super cheap, and the DUV news, etc., do you think that, I mean, do you think it makes sense that they could compete with these companies, or do you think it's just headlines right now that are driving these names down because, well, headlines is now, and then the results will have to wait for SanDisk, Micron, and everyone else to report their quarterly figures and guidance and see if something gets affected down the line, or what's going on?
Yeah, I mean, I think the market is really in a ask question, act now type of mood lately, where it's just like, oh, another competitor, even if you're not sure if the competition is really real, we're going to sell it off, right? It's more of like, I think the market just still doesn't trust AI. And I think maybe rightfully so when you're seeing companies invest crazy and you're not really in this AI pill craze. I can understand the bearish thesis and I can understand the negativity if I wasn't as AI crazed as I am. But being in my side and all kind of the AI stuff that we are seeing, I think the market is just It's just dumb for not thinking about the answer and just acting on knee-jerk reactions. Like you mentioned, kind of like that China news. I think that's a knee-jerk reaction to memory stocks. There were reports of certain delays, and that created kind of a sell-off in certain optics names. A lot of questioning about data center ROI, the kind of Kimi model, right? And then you had other situations in the AI innovation. You had this fight, this cybersecurity stuff that happened with OpenAI, and the market is just like, there's so much that we can't keep track on. We'll rather ask questions later and just act like all this is non-existent.
I mean, I didn't even know Marvel was down 50% as well. But then again, I assume this big jump right here is the Marvel is a $1 trillion company comment from Jensen. So yeah, okay, when you
I
go up
believe so,
64%, yeah, went up 64% in a matter of days, then I guess going down 50% since mid-June, so a bit over a month. 50% drawdown in Marvel, I guess it's a bit more attractive right now. We've seen that here. Micron down 40%, even Nvidia.
Yeah.
When Nvidia was $235, 191 right now.
I would say, Neil, you and I are both kind of similar. Maybe we don't hold the same names, but when the market is trending a certain direction, I think we're both very similar in what we do. And like I'm gonna guess the past few months prior to this downtrend, I was focused a lot on like the Max 7s, your Metas, your Microsoft, your Amazons, and stuff like that. I'm gonna assume you were very similar, right, Neil? And maybe
Unfortunately,
trimming
the Metas, but
the Metas, yeah.
but the Metas have not been kind to
No,
us.
not kind. But compared to like some of these other names, like I wasn't really trying to chase any high beta names a few months ago. Right now, I feel that completely changing. I think today was one of my biggest buyer days. I've been buying throughout this downturn, but today was just crazy. I think today is a crazy sell off. I actually went a little bit more aggressive than I normally do, and who knows, maybe that might bite me in the short term. But I'm pretty excited with a lot of these higher beta names and where they're sitting at right now.
I mean, with Microsoft, it's like this name has been down. It peaked at the end of 2025, and since then it's been just going down, 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 as if it's a shit go. And we're talking about Microsoft here. It's insane. Insane. I mean, Google, okay, Google is down a bit, but still over 300. Amazon, okay, off its highs here. Let's see, approximately 17, 18%. So yeah, even the Max 7 are beaten down, but of course, beaten down for them 15, 20% market cap wise is much, much bigger than a Nebius or a CoreWeave been down 50% or so. And Nebius is down 50% since the end of June. So literally in a month, cut in half. I assume CoreWeave is probably going to be the same here. I mean, that's since May it started. So yeah,
I think on the bright side, I don't think CoreWeave has gone up as much. So it right, like Nebius has gone up like crazy. So even
yeah, and Nebius went up to go down 50%. CoreWeave just didn't go up, and it still went down 50%. We're laughing, guys, but we should be crying. But yeah,
it follows the wrong trend.
But yeah, I mean, it's what are you expecting? I mean, yeah, maybe it's because PayPal is up. That's why. This is like upside down world. All of the AI names topped when PayPal bottomed.
Wild.
Quite interesting. But going into today's reports, what are we expecting? Let's start with maybe Meta. Chat can share its own thoughts about the report.
Yeah. So what am I thinking? I would love to hear a lot more about their AI model from Mark, right? I think in the past month, we've actually seen the model do extremely much better than I guess many anticipated. Meta wasn't even, I think, in a discussion in AI. Now it's there. It's all the way in the back of the class, but it's there, right? It's there. Back then, it wasn't even in the classroom. It wasn't even in the school. Now it made it to the back of the room. So love to hear more about that, especially since they kind of even introduced APIs with it. So they're now able to somehow monetize their AI token. So any kind of trajectory there of where that's moving. I'm also curious, obviously, on the compute story. We kind of are hearing these rumors with Anthropics. Management has talked about it in the past. Where does it sit now? And I also want a clarification on it. Are they doing this because they have too much compute, or is this market just so high margin in such a short term that it makes sense for them? Right? Because those two are, in my opinion, are two different things. And if Mark can kind of explain why they're doing it, if they decide to do it, that color would be great. And then obviously, Neo, just CapEx number. And would love to hear, kind of similar to Google, if there is a CapEx growth. I don't want to hear mainly based on inflation prices of memory. I want to hear that CapEx growth came in from just accelerated demand. And that's where they're purchasing. So those are some of the things I want to be listening to. Neo, how about yourself?
Yeah, so I'll start with your last point. I think this is what Google did, right? 3 months ago, I think Google and everybody else were talking about, okay, CapEx is going up because of high memory prices. Google this quarter said CapEx is going up, but they didn't say it's because of high memory prices. So maybe we're going to see that trend continue with the Meta and Microsoft later. With Meta, again, now that they have a model where I'd say they feel comfortable building upon it, releasing products powered by it, etc. We've seen them release more features and things like that in recent weeks, which I think is good. Do I think we'll get some specific numbers already? I think it's a bit too soon for that. I think towards the back half of the year, I mean, we should be getting maybe a bit more information, especially with the subscription business that they're setting up. I think that could be great. For the quarter, I mean, I expect negative free cash flow, just like with Google. I expect CapEx to go up. Will they tell us already that 2027 CapEx is going to be significantly higher? Remains to be seen. But I think this quarter is going to be, again, a strong quarter for them, revenue and EPS. Somebody said strong revenue growth, CapEx goes up, stock goes down, even though it's super cheap today for Meta. Will they talk about their possible cloud business? I assume it's going to be the topic in the earnings call. Otherwise, the analysts are just not doing their job. Yeah. So,
Neil, can you pull up? I'm curious to see how free cash flow has been for Meta these past few quarters, and also if you could just throw it in, like Google, like who has had the strongest free cash flow out of these two recently, prior to this earnings?
Let me pull it up. So, free cash flow. I've got way too many things here.
My goodness, what is this?
Everything possible. Actually, free cash flow margin, we'll add both. Then we'll do Meta.
And also, while you're getting that set up, Neil, I mean, we saw Google kind of take a hit after earnings. I mean, many people were saying and that it was due to the increase in CapEx and the free cash flow going negative. How much of that do you now think is kind of priced in for Meta? I would assume certain investors are going, if Google did this, it's safe to assume Meta's going to do the same thing. So do you still think we see a sell-off even though the market is somehow anticipating it? Or is kind of that scenario that, well, it is priced in, it's never truly priced in?
I mean, we saw Meta sell off a little bit after Google reported, probably because the market already assumes whatever Google did, Meta will do the same. But I will say that the market already assumed that Meta's free cash flow is going to be negative. I think they were quite surprised that Google's free cash flow this quarter was negative. And that's, I think, the big difference. Maybe they'll be shocked by, I don't know, a couple of billions of dollars, because I think right now, we'll look at it in a bit, I think the market is expecting close to $1 billion negative for Meta. If it's going to be way more, then I guess maybe that's the shock. But then again, still trading at under 20 times forward PE while growing 25% plus revenue. So quite an interesting thing. But this is the free cash flow basically over the last 12 months. We've got Google at $53.2 billion and a Meta here at 48.2. But
Okay.
that's the last 12 months. If you do quarterly, Google already reported, so we don't know.
Yeah.
But the expected number for Meta, we don't need 12 years.
Oh, Meta had higher last quarter.
So Meta, yeah, that was also a surprise last quarter. Market didn't really care that much. But for this quarter, as you can see, market is expecting negative.
Hey, market closed. The Microsoft is out. Come on, Neo. Come on. What is this, amateur hour?
I didn't even know it was already past 10. We're having so much fun here. So much.
Ding, ding,
so
ding,
much
ding,
fun.
ding, ding, ding. 2-minute timer.
Let me just pull up the Microsoft stock here chart here so people can look at the candles ticking tick-tock every second or so. For now, it's up a bit.
Nice. Let me see if I can find anything.
So Microsoft is up, as you can see, after hours. We're up 2.6%. But remember, ladies and gents, Microsoft guidance is only during the call. So whatever you see right now, the call usually adds more to the screen.
Wait, that's not red. What color is that, Neo? It's been a long time since I've seen.
It's been 84 years.
And is Meta's out and lower than expectations by a lot. By a lot?
Ooh,
let's
wow.
see it.
Meta is down 7% right now. Let me pull this one up.
So I see earnings per share is down. Earnings per share $6.18 versus $7.39 of estimates. But I'm not looking. I haven't seen it. I'm gonna guess it has to do something with some accounting rules and some of the AI servers depreciation.
Yes, we'll find out right now.
Meta Investors Relations.
Okay. So always a one-liner here opening. AI is accelerating our core business today, powering our next generation of products and opening the door to entirely new enterprise opportunities. Okay. That's already a new selling point for Zuck. The results are already showing, and I'm optimistic about the potential ahead. So what is this thing here? Rocket. There's definitely no rockets in the market in recent memory. So revenue is up 28% year over year. What did you say? They missed on EPS?
Yeah, it was supposed to be like $7 and something. And I think they reported like $6.
Okay. So revenue is up 28%.
Which was in line.
Which was in line.
Yeah, a small beat, like very small beat, like
1%. Yeah, okay.
Yeah.
1% beat and a 14% miss for EPS. Okay. Operating margin is also down from 43 to 31%. Net income is down 14% and EPS is down 13%. Okay, let's see. Family daily active people is at 3.6.
Just one thing that matters, they did not increase guidance, CapEx. The CapEx on the bottom end, on the top end, is still staying at $145 billion. They increased the bottom range. Prior it was 125 billion, now it's 130 billion. I know we're gonna get there eventually, but that's one of the big things to look at. So no guidance.
Okay, so the top end. Interesting. Very interesting. Okay. So the midpoint increased by a little bit, not by much. Okay. Surprising, no?
Yeah.
So they managed to increase the daily active people by 3% year over year to $3.6 billion. Ad impressions are up 14% year over year. Average price per ad is up 12%. So again, the core business here is doing extremely well.
Horrible.
CapEx for the quarter, 31 billion. What? Cash flow? So we have here cash flow of 784.
Free cash flow, yeah.
But let's see.
We have, okay.
Interesting. Very interesting. For the third quarter, they expect total revenue to be in the range of $61 to $64 billion. I don't know if it's a beat or a miss. Let's actually see if someone has this figured out already.
I just don't know how the market is going to play this. Yeah, I'm trying to see. The market is either going to be bad news it didn't increase CapEx on the top end, or good news it didn't increase CapEx on the top end. It's going to be bad news, which regardless. But
it's a very confusing and interesting report, I gotta say. So Q3 revenue is between 61 to 64. Estimated number was 63.2. Expenses, they raised the lower end, and then CapEx, like you said, same thing there, lower end. But they also expect fiscal year 2026. Where did that disappear? Fiscal year 2026 operating income to be higher than 2025. Yeah, to exceed 2025. Very interesting report here from Meta. How the free cash flow is a surprise.
Wait, why is it a surprise to you, Neil?
I thought it would be negative.
Negative?
Yeah. I mean, the market was also expecting to be negative. So
the thing that's crazy with these players, right? Also, it's like, were you not able to find power or stuff to build out your data? Like, there's so much things that can happen on a quarterly basis that could move out your movement a bit on free cash flow. Was there a delay somewhere? Did power didn't get turned on the week it was supposed to get turned on? So we'd love to hear a little bit some commentary there. But yeah, I mean, I don't think there's much information that I want to see here in the in this press release. Now I gotta wait for the earnings call.
Yeah, but the earnings call starts in
20 minutes.
20 minutes, so we have time for that. So let's jump quickly into the Microsoft one. We'll get back to Meta in a bit because anyways the call will start. Reality Labs is still losing $4.6 billion in case someone cared. We have here Microsoft with a double beat, 13% beat of EPS and 3% beat on revenue. For Microsoft, again, guidance and CapEx and all of that, I believe, is all during the call. So what do we have here? We actually
How much
only
did
care about
Azure
the growth. Yeah, exactly.
Yeah,
we just only care about that.
That's the only thing. It's been staying steady at like 39%, I think.
Yeah. So
it grew 43%.
Yeah, Azure and other cloud services increased 43%. Revenue in intelligent cloud increased 32%. So yeah, 43%. A nice little acceleration. I guess that the market is like, oh, actually, Microsoft is not a shitco anymore. Who knew? Who knew? All the rest here is relevant, but for the story and the team is a bit irrelevant for us. But still, Microsoft 365 Consumer Cloud increased 24%. LinkedIn is up 12%. Dynamic 365 increased 13%. So basically the whole group here, productivity and business, is up 14%. Xbox is down 10%. No surprise there.
Search and advertisement up.
Yeah, 10%.
10%. No, I mean, that's pretty. I think that's great to see 43% growth. I don't think we're going to be seeing kind of obviously the Google-based numbers just because Microsoft hasn't really. I mean, they said they continue to be really compute constrained, and they don't know if to give it internally or to kind of these cloud solutions. So we'd love to hear if that has changed. If the 43% growth is because they were able to turn on more GPUs than previously, or is it that they said, you know what, and this could be the bearish case, maybe they don't need it too much internally anymore, and now they're shifting it to external, like the cloud plays. And then that could be them talking a little bit, and the market can see that a little bit as a over compute capacity, which I don't think is the case. But I would love to just get that color, right? Because if Microsoft doesn't give the color of how they were able to grow Azure 43% compared to the prior quarters, I think the market can run with a lot of bearish stories.
Yeah, they say here Azure revenue surpassed $100 billion for the first time. Microsoft 365 Copilot reached over 30 million paid seats, reflecting the confidence customers are placing in us to power their AI transformation. I think it has more to do with the fact that they're forced to use Copilot over anything else because of cybersecurity reasons. But okay, I think today there was a report that Disney ditched Copilot to go with OpenAI Codex. So we'll see how that evolves with Microsoft. Again, it's a pretty boring report because everything gets mentioned during the call. So we can either go back to look at our screens here. Meta is recovering a little bit. It's now only down 4.3%. It was down over 7%. Microsoft is now only up 1%, as you can see. We roller coaster. As for the other names in the semiconductor space, we have Lam Research that's up 3.8%. I assume they reported good numbers. Maybe yes, maybe no. Who knew? Then ARM.
Qualcomm's down 6.7 digits. Yeah, sitting at 145.
Yeah, Qualcomm is down.
No.
Let's see.
I just don't get it, Neo. I don't know why. I mean, Microsoft just signed a massive deal extension with AMD, right? I think they just about a week ago, like literally a week or two ago, they signed that they were going to be purchasing more Helios racks, or going to be a big purchaser of Helios. And like the market seems to have forgotten that's happening already. It's like I see people. I was just looking on X that people are saying Meta and Microsoft are already thinking about slowing capex. I don't think that's happening at all. I haven't gotten that from anything here just yet.
For now, we haven't gotten anything. Like literally, other than the numbers, no information from management as to what they are seeing. Right, in 15 minutes, the call starts for Meta. And then in an hour and 15 minutes, the call will start for Microsoft, and we'll get way more information from both of them. In the meantime, ARM also reported. That one is currently down a little bit, but still a very expensive name for what we're getting here. So a double beat for ARM, a beat on EPS by 13%, a 1% beat on revenue. Okay. EPS is up 29% and revenue is up 22%. I mean, they're growing revenue slower than a Meta, and yet they're trading like, what is it, 100 times sales or something close to it? Maybe now a little bit less because it retraced, but it's still insane.
Lam Research also reported earnings. I don't have the numbers, but I do see the stock is up about 6% after hours.
Correct. Thanks for repeating what I said before.
Did you say that one already?
Yes. You see, I caught you. EPS beat by 8%, revenue beat by 1%. EPS is up 37% year over year, and revenue is up 30% year over year, and a nice increase quarter over quarter as well for both of these metrics. I think for those interested, we also have Robinhood that's up 1.2%, a double beat there. EPS beat by 44% and revenue by 2%. So.
And for those wondering why we're not streaming with Amit and Tanner, is because they didn't invite us. Just kidding. I think they're doing fintech today. They're doing fintech today, and we're here talking about the stocks that are bleeding.
They are doing Robinhood, and we are invited by Zuck and Satya Nadella because we're cool like that. But no, we'll be back with them tomorrow for Amazon, most likely.
Yeah, so we can all cry together tomorrow.
Yeah, because Amazon's earnings call are terrible. Like, terrible. Let's have a look at the neoclouds, because they usually move on whatever these companies report. Not that much, right? Nebius barely up 1%, CrowdStrike, CoreWeave 0.7, Iren like barely any moves.
Any movement, yeah. It was crazy though. The last 10 minutes, we saw like a massive sell-off on everything.
On everything.
I think, yeah.
Yeah, quite interesting. I want to go back maybe to Meta and see if we missed something. Where is it? Here.
Hey, Form Factor had earnings today too.
Who?
Form Factor. It's a memory kind of play. They're up 17% in the semiconductor play.
If they're up, they're no good for us. We only look at things that are down.
Yeah. We're only here for therapy session. If you're green, you don't deserve our attention.
The Meta presentation is only after they're done. Okay, cool. Not cool, but...
We got a comment here, Neil. Cal, about 416. Keep doing live streams, the two of you. It's much more entertaining. If only we used to...
Yeah, we used to do live streams until Jose said enough.
Enough's enough.
Because his portfolio was up. And now there's no portfolio anymore, which is why we're back.
So we're back at it. We're back at it. Live stream starting every day this week.
All day, every day. We'll be like those channels that run 24/7.
Oh, man.
It's good to laugh instead of crying. But yeah, I don't know. The Microsoft quarter is okay. It's fine. It's as expected. I'm not that astonished. But the Meta one is an interesting. It's an interesting one because of the results. And I was sure CapEx would have increased.
Yeah. Yeah, I wonder if that's going to be a question, and maybe they could just say, "Hey, timing." Maybe they don't have the for them. It could be our data center that we expected to be turned on in December is now going to turn on in January. So we're gonna. I think what's going to be better is kind of the commentary of what's next, what's 2027, because if they don't just want to buy GPUs or AI stuff if they don't have the power shell behind it. And who knows? Maybe some of those they're not too comfortable that they might get it this year. But that's the bullish, crazy guy in me thinking
Didn't
that.
Semi-Analysis say that they expect insane increase in CapEx from Meta for 2027?
I think so.
So maybe they are holding off for 2027 in order to increase, or maybe the next 2 quarters or so. I don't know. But it is interesting. It is interesting. And that free cash flow is a very pleasant surprise, although maybe we've missed something. As for the Microsoft CapEx guide, again, anything guide related for Microsoft is only during the call, never during the report, which is why the stock usually has a nothing burger move before the call starts.
Chipotle also reported earnings, just if you're curious. They're up 6%. Yeah.
I guess anything.
Let me just say, the past few months I've been buying double steak and guac. I think I'm gonna be not doing that the next few months.
How much does a bowl cost nowadays?
I don't know. When I just know when I go with my wife and my little one, it's I think like $43.18.
Jeez.
But like I said, double steak, guac. My little one likes guac too.
I mean, a man's got to eat, right? So a man's got to eat. Okay, Meta down 5.7, Microsoft up 2. The others don't even move, like Oracle. What's up with this one? 117. And Oracle is also an interesting one right now, because they better see accelerated revenue growth and more recognition, because otherwise, I mean, the bears are just going to keep putting this name down lower and lower. Oracle or CoreWeave? What are you saying
CoreWeave for
nowadays?
sure. 100% CoreWeave. I mean,
Why?
what, $33 billion market cap, 1 gigawatt of active power. It's
$100 billion backlog.
$100 billion backlog, right? They to me, it's like they don't. One thing with Oracle, at least, is like you come with added debt, right? Debt from prior acquisitions that you've done and stuff like that. Any debt that CoreWeave is coming is just coming mainly from kind of like the compute story. So to me, it's kind of like a fresh compute play, where like Oracle, you have a lot of the baggage, right? And sometimes the baggage is okay, but
Fortinet cybersecurity, for those that are interested, is also up close to 9%, double beat. EPS beat by 20%, revenue by 8%. EPS is up 41% year over year. Revenue is up 26% year over year. Not bad at all. It's probably one of the only cybersecurity names that is not that expensive compared to all of the rest.
This was the one. Sorry, I broke down for a second. This was the one that made a partnership with Intel, right? I think for Foundry. Was it Fortinet?
Was it Fortinet?
Yeah, Fortinet and Intel.
Let's see.
Am I the chip guy or am I not the chip guy?
Yes. Intel and Fortinet announced a strategic collaboration to develop Fortinet Security Processor 6.
On their Intel 3, I think. And I think it's the first time Intel actually has an external customer on their Intel 3 platform. Which I don't know wasn't really discussed too much during the earnings call, but I thought that was pretty cool. Like Intel 3 was not meant for external customer usage, but they seem to have gotten some traction there.
Okay, so they said that the Fortinet SP6 chips will be fabricated using the closely related Intel 4 EUV process nodes.
Okay.
The more you know. The more you know. But
wait, are you no longer an Intel guy, Neil?
I am an Intel guy. I don't have Intel shares anymore. I had my options.
Yes,
should have held on to those options, or just converted to shares, because it was at $40 for like 4 months in a row, and then poof, exploded at the end of March. But yeah, where is it now? Back in the 80s, yeah.
Is it? Oh wow,
80. Wow,
that's wild. Yeah,
it was at 140.
I thought it was still at 100.
Okay, I mean, but let's be honest, at 140 it didn't make much sense. Like the PE there was still negative 300, or I don't know what was there, but what the ship just happened, Jose, because this is what people want to know. What the ship just happened. All of these names have gone down like they are garbage names, whether it's semiconductors, NeoCloud. What is this?
The market, I don't know.
The story is over.
The market thinks AI is done. Yes, that's the thing. Market is stupid, Neil. That's it. It's it. I can't. I don't know. The market is worried. It is worried. But I mean, everything we heard, right? TSMC had great earnings. They told us they saw visibility 2029, 2030. I mean, we had ASML kind of tell us a lot about the demand, and ASML is kind of being a little bit hesitant on how much equipment they build. So ASML is also becoming kind of like a bottleneck in the future. So that's something I enjoy, right? If ASML is kind of creating a bottleneck on how much chips can be produced, it makes the cycle go a lot longer. I forget what other earnings we had. I mean, Google telling us Google Cloud is growing, Azure growing much stronger now than they had in the past. I can't see, and maybe because I didn't have my glasses for the past few days, I can't see a reason why the market
is. It's so the South Korean gamblers.
Yeah, those gamblers, man, freaking degenerates.
Every morning I wake up, I look, South Korean market, I don't know, triggered is stop a call, like it's down 6%. It's like every
day. It's like, when do you guys break?
These guys maybe they're running a real Squid Game experiment on the stock market. I don't know what the heck's going on there, but Like it could, I don't know.
Yeah, I feel like every day down 8%. I'm like, geez, again.
It's like this Simpsons reel. Like, he's already dead. Stop.
Stop it.
But yeah, I would be way more worried if the results sucked from all of these companies. But it's the exact opposite. Like, Google absolutely crushed it. ASML crushed it. TSMC crushed it. Intel actually crushed it as well. Meta is doing fine, although with like more context. Same with Microsoft. Tomorrow we have Amazon, although Amazon is a completely different beast. But yeah, it's quite interesting.
And like, I mean, to me, Neil, I'm not trying. Even if there's more memory, right? Let's just say there is more memory. I know I saw some people saying, because of Chinese entering the memory market, it's going to overflood. I think even if there's more memory, it doesn't necessarily mean the AI story is done. And I think this is one thing that that the market is putting together. They kind of put, if the optic shortage ends, that means the AI story ends, or if the memory shortage ends, that means the AI story. I think the market keeps putting everything as exclusively mutual, but they're not, right? They're not. Each of them can end, and the AI story can still continue for a while. So, but I mean, there's a lot of fears. Just there's been delays, rumors of delays for so many companies, so many new competitors coming into the space. I think it's just been a flood of bearish news in the past month or so.
With the results saying the exact opposite, which is ridiculous. So again, for those that are new or just joined in, Meta capex wise, they only increased the lower end of their capex from 125 to 130 to 145 billion dollars. Microsoft, we have to wait until the call, and the call happens in an hour. In 2 minutes, we have Meta, so we'll switch from one to the other. Although we first will have a quick review of Meta's call, because we don't care about the first 10 minutes or so from Microsoft, because they're just going to repeat the same thing we just read during the press release. Do you have any options or leaps or something for some of these high flyers? Or high flyers, the deceased high flyers.
For the ones that are dead in the ground, yeah. Right now, I have I have options on the NeoCloud players. It's crazy to think how, I don't know how excited I am about these plays. So CoreWeave and
leaps?
Yeah, leap spreads.
Okay. Yeah, now I'm quite happy with my because I had pure shares for CoreWeave and I transformed them into leaps, $60 calls for 2028 January. And now I'm like, we are at 61 today. So I'm like, okay, I have time until we go back up, if we go back up, because you never know.
Yeah. So I've been actually doing a mixture of both. I think today though was mainly pure stock buying.
Yeah. I mean, cheap stock can then sell covered calls once we go back up, collect some premium, and buy more Chipotle.
Yeah. I'm so sad when I'm going to tell my little one, you can't get guac this time.
Why is that? Data centers.
Data center.
That's why data center gets a bad rep. Let me see if we have some music already for the...
Yeah, Neil's making sure we don't got music. Like we said, we need the funds, so we can't be demonetized.
For now,
what did I
music.
Buy? All right, what did I buy today, Jose? I bought CoreWeave, Iran, and Air Test technology.
Man, Air Test systems is crazy run this year. I know for the past 12 months. Where is it? Meta call still hasn't started.
Yeah, it hasn't.
The AI is here.
Until that time, your lines again will be placed on a music hold. Thank you for your patience. Okay, back into a private mode. Amy, waiting on your begin. Okay, so we are going to go live momentarily. There will be a
We got
brief
music,
pause
Mia.
as we start the webcast. I'll begin my introduction and turn the call over to Mr. Heaton. As a reminder, your lines are open, and anything that you say will be heard into the main call. Are we ready to begin?
DJ Neo.
We are ready to go.
I hope they
There will be a brief
put out the
pause as we
music.
start the webcast. Please stand by for my scripting.
Okay, no echo anymore, right? Okay, good.
Good afternoon. My name is Krista, and I will be your conference operator today. At this time, I would like to welcome everyone to Meta's second quarter 2026 earnings conference call. All lines have been placed on mute to prevent any background noise. After the speaker's remarks, there will be a question and answer session. If you would like to ask a question, please press star, then the number 1 on your telephone keypad. To withdraw your question, again, press star 1. We ask that you limit yourself to one question, and this call will be recorded. Thank you very much. Chad Heaton, Meta's Vice President of Finance, you may begin.
Thank you. Good afternoon, and welcome to Meta Platforms' second quarter 2026 earnings conference call. Joining me today to discuss our results are Mark Zuckerberg, CEO, and Susan Li, CFO. Our remarks today will include forward-looking statements, which are based on assumptions as of today. Actual results may differ materially as a result of various factors, including those set forth in today's earnings press release and in our quarterly report on Form 10-Q filed with the SEC. We undertake no obligation to update any forward-looking statement. During this call, we will present both GAAP and certain non-GAAP financial measures. A reconciliation of GAAP to non-GAAP measures is included in today's earnings press release. The earnings press release and an accompanying investor presentation are available on our website at investor.meta.com. And now I'd like to turn the call over to Mark.
All right. Hey, everyone. Thanks for joining today. We had a strong quarter for our community and business with 3.6 billion people using at least one of our apps each day. We reached several milestones. Instagram reached 2 billion daily actives. Threads crossed 500 million monthly actives, making it the fastest growing conversation app ever. Facebook has reached more than 2 billion daily actives for a while now. WhatsApp just hit an all-time messaging record, peaking at 30 million messages sent per second during the World Cup final. And also, Kunal Shah just joined as our new head of WhatsApp. He built one of India's most important payment companies and will be a great addition to the team. We also shipped some strong new models from Meta Superintelligence Labs and released new glasses. Overall, the scale and reach of our community across our apps is pretty remarkable, and it gives us a strong platform for delivering new innovations to billions of people. The opportunity in front of us is massive. First, we are now at a point where our investments in AI are accelerating every major part of our core business. They're improving the experience for people using our apps, driving better performance for advertisers, and helping our teams build new experiences and ship faster. Second, we are developing new personal agents that will be the foundation for our next wave of products and revenue lines in the months and years ahead. And third, we see a large enterprise opportunity to sell to businesses, including APIs, business agents, potentially selling compute directly, and other services that we're building for large customers. And I want to spend some time today laying out exactly how our investments are delivering results today and the opportunities that we see over time. For accelerating our core business, we are seeing strong and promising results in several areas. In Instagram and Facebook, I'm very optimistic about our work to integrate large language models into our recommendation systems. LLMs add a first principles understanding of what the content is about and why it is compelling, as well as a deeper understanding of what people are interested in and what their goals are when they're using our apps. So this means that we can show more relevant and engaging content that better reflects people's goals and interests. Our new Muse image and Muse video models will also dramatically expand the universe of content that people can discover across our platforms. There are already 2 large sets of content to draw from, first from your friends and the people you follow, and second from creators that you don't follow. But now there's going to be a whole new and nearly infinite universe of personalized content. And this is going to make our services a lot more useful and engaging for people. For ads, we're using LLMs to improve how our systems predict and rank the ads that we show. We've expanded the context that we can take into account around a person's organic and ads activity to determine an ad's relevance, driving significant increases in relevance and conversions on both Facebook and Instagram. And on a dollar basis, our ads business is reporting faster year-over-year revenue growth than any other company's reported ad business. So these AI investments are paying off. We are also seeing a lot of demand for our new AI-powered creative tools. 9 million small businesses on our platforms are now using at least one of our AI ad creative tools, and we're rolling out new end-to-end creative solutions that help advertisers translate performance data into their creative decisions. Muse Image is going to supercharge this. The model can analyze images, improve its own work, and produce better ad variations based on advertiser input. We're getting great feedback on this so far. We also just launched Meta One, a new subscription offering that provides more tools and AI features across our apps. As demand grows, we're going to offer a variety of different tiers and pricing options there as well. And I'm also excited about how AI is helping our teams speed up product development. Earlier this year, we shipped Instagram Instance. We also just launched Forum, a standalone groups app, and Seller, a standalone marketplace app. And I expect it to become a lot easier to ship new apps. So we are planning to build out more ideas and use our recommendation systems to scale them to the people who will find them interesting, as we've done with Threads. It's been a little more than a year since we launched Meta Superintelligence Labs, and our trajectory is strong. In the last month, we shipped Muse Spark 1.1 and Muse Image. Since we rebuilt Meta AI and integrated Muse Spark, we have seen a 60% increase in the number of people interacting with the assistant each day, and that continues to grow quickly week over week. Muse Spark 1.1 is a strong agentic encoding model that is very efficient and excels at computer use, tool use, and multimodal understanding. It's available through our new public API, and we are ramping up distribution through partner channels and more coding agents over the coming weeks. We are also building out features to make it easier for enterprises to adopt Muse Spark, and that is an area that we expect to continue focusing on. One reason that we are so focused on making Muse Spark great at agentic capabilities is that we think that there's a very big opportunity to ship a few types of agents that are aligned with our mission and business. The first is personal agents. Soon, we will have agents that can work 24/7 on your behalf to help you achieve your goals and improve your life, your health, your relationships, your finances, whatever you want. The first domain that agents have really taken off in is coding, but engineers are more technical and willing to spend time making those agents work. So to build great personal agents, this needs to be a great consumer product that just works out of the box and is easy enough for billions of people to adopt and use. I'm very excited about this, and we're going to have more to share soon. As we move towards a future where we're all interacting with multiple agents, I think that WhatsApp and our other messaging surfaces are going to become increasingly important. WhatsApp is already the leading surface where people engage with Meta AI. And as we build out a platform for more agents across our messaging apps, we're going to innovate on how to deliver a private and secure AI experience. We launched incognito mode this quarter on WhatsApp and the Meta AI app, allowing people to have private conversations with their assistant that even Meta can't see. We're planning to make strong privacy and security a fundamental part of the agents that we're building as well. I'm also very excited about our progress with business agents. We made Meta Business Agents available globally this quarter on WhatsApp and Messenger, and there are already more than 1 million businesses using them to talk to their customers or complete sales every week. We're rolling business agents out on Instagram now too. One interesting thing about having an agent talk to your customers every day is that it learns over time and can bring all of those insights back to you. So we're building more agentic capabilities to summarize all of these conversations, digest what happened overnight, and surface what customers are asking for. And soon it'll go further, including suggesting ways to grow your business, giving you competitive intelligence and real-time insights into what's working and what's not. And over time, we'd like to build this into a business-in-a-box service that can help you start and run a whole business using Meta's platforms. In terms of how we will monetize these, we have a mix of subscriptions, volume-based pricing, and I expect that we're going to continue to evolve more of these products to be like our ad systems, where businesses only pay us when we achieve results for them. Over time, that will let us run an efficient auction over our compute, similar to how we do that for advertisers today. As AI usage in our products and businesses continues to ramp, we continue to invest aggressively in infrastructure to meet the demand. Yesterday, as part of our Meta Compute effort, we announced a new strategic venture with BlackRock to develop a new 1 gigawatt data center in El Paso, Texas. Overall, we expect that a significant portion of our compute is going to go towards training our models, growing our core business, and delivering personal agents and new products. But we also expect to grow a large business serving large customers as well. We've built our API, we're rolling out business agents, we're getting a lot of offers for compute at a significant premium over what we paid for it, and we have more coding and productivity tools on our roadmap as well. And we'll have more to share on all of this soon. As we get closer to personal superintelligence, we are also going to need hardware that allows you to seamlessly interact with it. Glasses are the ideal form factor since they can be with you throughout the day and they can assist you without pulling you away from the moment. Our glasses remain one of the fastest growing consumer electronics of all time, and we continue adding to the lineup. We just released our own line of Meta glasses in collaboration with EssilorLuxottica, including a style that we designed with Kylie Jenner. They're the first glasses to ship with Muse Spark out of the box so that they can understand what you're seeing and give even more helpful answers. Early sales have been strong, exceeding our expectations, and we're going to have more to share on our glasses lineup at this year's Connect conference on September 23rd, so I encourage you to tune in then. Before I wrap, I want to mention that I just published an op-ed about why I'm so optimistic that we are building a positive future for everyone. At Meta, we have always built technology to put power in people's hands so that they can connect with the people they care about and shape the world in the ways that they want. It's why we've always focused on making our products affordable and accessible for everyone, and it's a strategy that has served both our community and our business well. As we enter this next chapter, that same philosophy is guiding how we approach developing AI. We're the only major company building AI with the primary goal of putting superintelligence directly into people's hands. Rather than centralizing superintelligence, we're focused on distributing it widely and giving everyone the ability to direct it towards what matters to them. That's the way that society has always made progress. I think that these are the right values for building a positive AI future. And if we help build this, then I think that we will continue to build a very strong business as well. So that's everything I wanted to cover up front today. AI is improving our core business. It's making our apps more relevant and delivering better results for businesses. We're starting to deliver more novel products, and we'll have a lot more there soon as well. And we are investing aggressively because the potential is huge, and we know that there are many ways to deliver value here. As always, I'm grateful to all of you for being on this journey with us. And now, here's Susan.
Thanks, Mark, and good afternoon, everyone. Let's begin with our segment results. All comparisons are on a year-over-year basis, unless otherwise noted. Q2 total Family of Apps revenue was $60.4 billion, up 28% year-over-year. Q2 Family of Apps ad revenue was $59.4 billion, up 27%, or 26% on a constant currency basis. In Q2, the total number of ad impressions served across our services increased 14%. Impression growth was healthy across all regions, driven by growth in engagement and users, as well as ad load optimizations. The global average price per ad increased 12% year-over-year, driven by ad performance gains, improvements in macro conditions relative to Q2 of last year, and currency tailwinds. This was partially offset by strong impression growth, particularly from lower monetizing surfaces and regions. For the first time, quarterly Family of Apps other revenue reached $1 billion and grew 73% year-over-year, driven primarily by WhatsApp paid messaging and subscriptions revenue. Within our Reality Labs segment, Q2 revenue was $431 million, up 16% year over year due to strong growth in AI glasses revenue, partially offset by lower Quest headset sales. Moving now to our consolidated results. Q2 total revenue was $60.8 billion, up 28% or 27% on a constant currency basis. Q2 total expenses were $42 billion, up 55% compared to last year, and included $2.4 billion in charges related to legal proceedings and $1.2 billion in severance expenses in connection with the May 2026 headcount reduction. Year-over-year growth was primarily driven by increases in employee compensation, infrastructure costs, legal-related costs, and third-party AI token costs. Excluding the previously mentioned severance expense, growth in employee compensation was driven by technical hires we've added over the past year, particularly AI talent. The growth in infrastructure costs was driven by higher depreciation, data center operating costs, and third-party cloud spend. We ended Q2 with over 75,000 employees, down 3% from Q1. This total includes approximately 8,000 employees impacted by the May 2026 headcount reduction. We expect the majority of impacted employees will no longer be captured in our headcount by the end of Q3 2026. Second quarter GAAP operating income was $18.8 billion, representing an 8% decline year over year and a 31% operating margin. Excluding the Q2 legal charges and severance expenses, our second quarter operating income would have increased 9% year over year. Our tax rate for the quarter was 16%. Net income was $15.8 billion, or $6.18 per share. Capital expenditures, including principal payments on finance leases, were $31.1 billion, driven by investments in servers, data centers, and network infrastructure. Free cash flow was $784 million. We ended the quarter with $90.3 billion in cash and marketable securities and $83.7 billion in debt. Turning now to the business performance. There are two primary factors that drive our revenue performance: our ability to deliver engaging experiences for our community and our effectiveness at monetizing that engagement over time. On the first, we continue to see significant gains from our content recommendation initiatives. On Instagram, global time spent this quarter grew double digits year over year this quarter, largely driven by improvements to our feed and Reels recommendations. On Facebook, video time spent increased 9% globally year over year and over 10% within the US and Canada, where it was driven by ranking improvements. We are finding that LLMs are increasingly capable of delivering ranking and recommendations gains. First, they make our existing systems smarter by understanding what the content is actually about and generating better training data. Second, LLM-powered agents are also helping with engineering development by evaluating content quality, detecting trends, and testing ranking changes. Earlier this year, we reached a milestone of every public Reels and feed post on Instagram being automatically processed through an LLM and analyzed across dimensions from topics to tone, and we're working towards including more surfaces on Facebook as well. These signals can then be passed to downstream applications across ranking, recommendations, and content policy enforcement, which is a key building block toward greater personalization. This quarter, we also began using our Muse family of models to conduct content understanding across signals like video topic classification and summarization, and we've seen positive early results. Finally, our recommendations are also becoming more personalized, surfacing more fresh content while giving people more direct control over what they see. On Reels, we shipped our largest single release ranking improvement to date, combining faster inference with a new architecture that draws on deeper user history to improve predictions. This drove a 15 basis point increase in sessions on Instagram, with particular strength in reshares and time spent, which are both strong indicators of better content to user matching. We are now bringing this to feed where early results look comparable. We are also getting new content to people more quickly. Investments we've made in more real-time infrastructure and modeling improvements on new videos are allowing our largest ranking models to now identify high-quality new reels at creation. On Instagram feed, over half of all recommended content is now less than 1 day old, more than double from a year ago. We're also giving people more direct control of the content they see. Today, Instagram users can visit the Your Algo page, which lets users write natural language prompts to tune their recommendations. Similarly, on Facebook, we launched Shape Your Feed. Early results show over 80% retention among users who engage with it. Looking forward, we're executing on our longer-term efforts to develop the next generation of our recommendation systems. This includes building foundation models that are designed to power organic content and ads recommendations simultaneously, as well as developing LLM native recommender systems. We hit our first research milestone this half by continuously pre-training a large-scale model with recommendations data and observing healthy scaling laws in the process. We're encouraged by this milestone and expect continued progress in the second half of the year. Turning to the second driver of our revenue performance, increasing monetization efficiency. The first part of this work is optimizing the level of ads within organic engagement. Here, we continue to enhance our systems to show ads at the optimal time and location. In Q2, we also expanded availability of ads on our newer surfaces, including completing our global ads expansion on Threads. On WhatsApp, we have introduced support for more types of ad destinations and advertiser performance goals in status and continue on track toward our global rollout. Moving to the second part of increasing monetization efficiency, improving performance for the businesses who use our services. Within our ad systems, we're delivering performance gains as we deploy more complex and predictive models. This quarter, we introduced Meta Generative Recommender, a paradigm shift in how our ad system works. Rather than scoring every possible ad individually, we are now using LLMs to reason about ad content and user preferences together and predict the best ad for each person. This makes our ad matching more intelligent and more precise, which compounds performance gains for advertisers. We deployed the first generative model into our ads retrieval system and saw notable improvements in ads performance. Early pilots using LLMs to better understand user preferences drove a 1% increase in app event conversions on Instagram. In Q2, we also advanced our user understanding models to analyze ads and organic activity and simultaneously improve both user experience and advertiser performance. Combined with our GEM model for ads ranking and sequence learning, these advancements generated an 8.3% increase in ad clicks and a 15.7% uplift in conversions on Facebook. We're also leveraging AI to empower businesses to more easily manage their campaigns, develop ad creative, and engage with their customers. Our AI-powered Advantage Plus end-to-end solutions continue to grow, reaching over $75 billion in annual revenue run rate this quarter. We're working to deepen adoption as advertisers who leverage multiple tools see compounding performance gains. I'll share one example of how Advantage Plus is making performance marketing meaningfully easier and more effective for SMBs. Underneat, an online apparel brand in India, had been setting up each campaign manually across Facebook and Instagram. After adopting Advantage Plus sales campaigns layered with Advantage Plus audience placements and budget optimization, they saw a 13% incremental lift in purchases and a 16% increase in add-to-cart conversions. Adoption of our GenAI ad creative tools continues to scale, with over 9 million small businesses using at least one AI creative tool. Image generation, which now lets advertisers produce more creatives at scale from existing content, including a new ability to create images from video assets, saw adoption more than double this quarter. We also introduced a new end-to-end creative solution that gives advertisers the AI infrastructure to translate real performance signals into their next creative decision, while preserving brand identity and tone. We're building with agency integrations from day one so teams can diagnose, generate, and scale high-performing creative without leaving their existing workflows. Looking ahead with the rollout of Muse Image, we expect to further expand advertisers' ability to generate high-quality, on-brand creatives at scale. With Meta Business Agent, businesses are better able to serve their customers through our messaging apps by responding to inquiries, recommending products, and handling support around the clock. Earlier this month, we also introduced the Meta Business Agent platform, which gives enterprises the infrastructure to build, customize, and deploy their business agent at scale on WhatsApp. The platform provides larger businesses with enterprise-grade controls, guardrails, and measurement built in, so they can define rules and offer personalized experiences, starting within the messaging apps that their customers already use. Movida, one of Brazil's largest rental car companies with nearly 400 locations, deployed a business agent on WhatsApp to handle the entire booking flow, from vehicle selection and pricing to payment, in a single conversation. Returning customers could complete a reservation in as few as 3 messages. In a 1-month period, Movida reported a 44% increase in daily bookings through WhatsApp when compared to the same period in the prior year, and that 85% of conversations in the channel were resolved entirely by the AI agent without human assistance. We're also building out additional ways to monetize our ecosystem. 2 additional revenue streams are subscriptions and monetizing our competitive models through an API. Meta One is an evolution of our subscription portfolio to create more value for everyday users, businesses, and creators, so they get more features and AI tools to create, connect, and stand out. We are excited to bring this to more users and continue to build enhanced tools for our subscribers. We also recently launched a high intelligence model API at a competitive price and are encouraged by the initial results. We recently made Muse Spark available on OpenRouter for US-based developers, broadening its distribution and making it easier for developers to adopt the model. We soon expect to roll out the model API to more distribution channels, make it available in more countries, and open it up for enterprises. Our approach to building capacity is strongly influenced by several key elements. First, the broad environment for building infrastructure is dynamic and uncertain in both near-term and longer-term time horizons. The industry has underbuilt historically for the wave of AI adoption, making existing capacity, including our own, extremely valuable. Longer term, the supply chains need to be built out to support the capacity that we anticipate we and others will need for AI-powered experiences. Second, we have high confidence in our ability to utilize capacity to scale and build on top of our existing experiences, as well as continue to invest in foundational models that will create substantial new opportunities. Consequently, our current plans are geared towards maximizing 2026 and 2027 capacity. When we have had incremental capacity in the past, it has proven extremely valuable in scaling experiences like Reels, and we are confident that this will be true in this timeframe as well. Longer term, it's harder to predict the exact usage scaling curves, but we believe that our distribution advantages will give us the opportunity to serve AI products that are valuable for everyone, both our 3.6 billion users and millions of businesses. This should be true regardless of whether our models are on the frontier, but we believe that being on the frontier will unlock new markets and opportunities for which we may need additional compute. Therefore, our longer-term capacity strategy aims to give us the flexibility to continue growing compute in 2028 and beyond by laying down data center and network foundations to accommodate future server decisions. The long-lived nature of these assets inherently provides the flexibility that will make it possible to adjust our investment to the pace of AI adoption. In addition, we have been making strategic investments in areas like our internal custom silicon effort, which will provide long-term strategic flexibility and supply chain leverage. This will be helpful in driving better returns on those long-term investments. Finally, we believe that overall industry capacity is going to remain tight for the foreseeable future. As we've said earlier, we strongly believe that the models, consumer experiences, and enterprise offerings that we are building will be the best and highest ROI use of our infrastructure. Those enterprise offerings have the potential to take multiple forms, as Mark mentioned, agentic tools, our API, or monetizing compute directly given outsized market demand. We expect that remaining nimble about these opportunities will help us fund our build-out more efficiently while preserving our strategic flexibility to have the compute when we need it and provide us multiple pathways to generate returns on invested capital. In funding these infrastructure investments, the strength of our balance sheet gives us the ability to attract capital from a wide range of markets to supplement the cash flow generated by our business. Our announcement with BlackRock yesterday is an example of the partnerships that we can structure to complement our approach to building infrastructure capacity. Moving now to our financial outlook, we expect third quarter 2026 total revenue to be in the range of $61 to $64 billion. Our guidance assumes foreign currency is an approximately 1% headwind to year-over-year total revenue growth based on current exchange rates. Turning to the expense and CapEx outlooks. We are raising the lower end of our expense outlook to incorporate the $2.4 billion charge related to legal proceedings recognized in Q2. We now expect full year 2026 total expenses to be in the range of $165 to $169 billion. We continue to expect to deliver operating income this year that is above 2025 operating income. We anticipate 2026 capital expenditures, including principal payments on finance leases, to be in the range of $130 to $145 billion, narrowed from our prior outlook of $125 to $145 billion. Absent any changes to our tax landscape, we expect our tax rate for the remaining quarters of 2026 to be between 15% to 17%, an increase from our prior outlook of 13% to 16%. Finally, we continue to monitor active legal and regulatory matters that could significantly impact our business and financial results. For example, we continue to see scrutiny on youth-related issues in several markets and have a number of youth-related trials scheduled for this year in the U.S., which may ultimately result in a material loss. In closing, our business momentum continued in Q2 with strong execution across our core ads and engagement initiatives. We're also progressing in our efforts to bring personal superintelligence to everyone with exciting model releases, and we expect to build on that momentum over the course of this year with new products. With that, Krista, let's open up the call for questions.
Thank you. We will now open the lines for a question and answer session. To ask a question, please press star 1 on your touchtone phone. To withdraw your question, again, press star 1. Please limit yourself to one question. Please pick up your handset before asking your question to ensure clarity. If you are streaming today's call, please mute your computer speakers. And your first question comes from the line of Brian Nowak with Morgan Stanley. Please go ahead.
Thanks for taking my questions. I have two, one for Mark, one for Susan. Mark, I appreciate all the color on the big pipeline for new products across consumer and business agents, API tools, and compute rental. There's a lot of opportunities here. My question is, as you look at these opportunities and the state of the current offerings, the compute capacity, which of them do you expect to be able to scale first, sort of in 26 and 27, to sort of showcase quantifiable material ROIC for investors? And then Susan, there's been some public comments about capacity in 27 and doubling capacity, and I appreciate your color about CapEx. Any early comments on 27 CapEx, even the philosophy around sources of upside or sources of downward pressure, just sort of think through different ways to finance this multi-year build and have 27 CapEx?
I can take the first one. So in terms of the different opportunities and how we think about the compute, overall, a substantial amount of the compute goes towards training models to be a leading lab. And I think that that's an important investment. But then the rest of it goes towards a set of different products and revenue opportunities, which spans from optimizing and improving our core business to building new consumer products that we're releasing soon, to the API, to the business agents work, to the developer tools work on the roadmap that I alluded to, and then also the opportunity to sell compute directly, where I mentioned that we have quite a number of offers at a meaningful premium over what we paid for the compute. The question in thinking about this is, we believe that there will continue to be a significantly higher margin on selling intelligence rather than selling compute directly. But we think that there's a big opportunity, obviously, to sell compute as well. So we're thinking through. I think you asked what one area would likely scale the most, but I mean, I'm actually quite optimistic that we're going to see meaningful growth in all of these areas, and I think we will have more to share soon on a number of them.
Brian, on your second question, we aren't providing a specific outlook for 2027 CapEx at this time. Infrastructure planning remains highly dynamic. And even this year, there are a range of outcomes embedded in our outlook. I alluded in my main remarks to our focus on gearing our current infrastructure plans towards maximizing capacity in 2026 and 27, and giving us the flexibility to continue to grow in 28 and beyond, but also giving us the ability to make server decisions, when we come to our being able to evaluate our actual needs in 28 and beyond. So we're still working through what our capacity needs are going to be over the coming years. Generally, we believe near-term capacity is more valuable than long-term capacity. And it remains a very dynamic planning process.
Your next question comes from the line of Eric Sheridan with Goldman Sachs. Please go ahead.
Thanks for taking the question. Maybe two, if I can. When you frame up the enterprise opportunity, how much of that opportunity do you think is available to you today based on what you've built out in terms of go-to-market strategy as extensions of the advertising and the marketing business you have already versus go-to-market strategies that might have to be built to capitalize on the opportunity? And then maybe, Susan, if I could just squeeze a second one in. When you think about sources of capital for the business for the next couple of years, you referenced the deal that was announced yesterday as an example of looking at ways to finance forward obligations. We continue to get questions from investors about how to think about the mix of debt and equity and sources of capital. Philosophically, how are you guys thinking about wanting to be ambitious on the spend, but then marrying that with the need for capital? Thanks so much.
Sure, I could talk about the first part. I think for enterprise, there's going to be a combination of extending the current business, which is effectively selling to marketers and businesses that are like basically customer facing, trying to reach customers and sell to them directly. Obviously that's the vast majority of the business across Facebook and Instagram, and we believe that there's an opportunity to extend this with business agents across messaging apps and other surfaces to continue to interact with customers. And just like the ad system, effectively, we will get paid when we deliver results for those businesses. So we view this as an extension of the sales and the partnerships that we have with many millions of advertisers and hundreds of millions of small businesses that use our platforms. So that one, I think, should be quite a natural opportunity for us. And we're focused on delivering it in a way where we're not trying to kind of maximize the sale in the near term. We're trying to maximize the results for people and build out a robust auction, and that's what we've seen has served the business well over time. There are other enterprise customers who I think we're increasingly going to serve too. We're building coding and developing an internal productivity tools partially because we need to build them ourselves, and we need to make sure that we have tools that are tuned for ourselves. And now that we have those, we feel like there's a large opportunity to serve, whether that's small businesses or larger businesses. That is a somewhat different muscle than we have historically had, and we will share more soon on how we're planning to build that out. But I think that there is just a very large opportunity on this. And the way that I think about this is there's obviously been a bunch of news about the compute side, but I think that the enterprise opportunity is kind of the sum of all of these different things. It's not just the selling compute, also the API services, the productivity services, the kind of business agents for other parts of the business beyond marketing are all parts of the overall offering. And I think that there's just a very, very large opportunity there. So we're quite focused on that. That's going to be somewhat of a new muscle that we build as a company, but I think it's a very important one that we build so that way we can make sure that we can maximize the opportunity ahead of us.
Eric, on your second question, in terms of sources of capital, this is something that we have been looking at thoughtfully as we think about financial planning for the future. Obviously, our strong operating cash flow certainly has put us in a position of strength as it pertains to funding our infrastructure build out. But we've also been evolving our capital structure in recent years to include a greater mix of debt as we work to bring down our cost of capital. And we have generally found it prudent to continue adding cost-efficient, long-duration sources of capital as we make investments in initiatives that themselves have long time horizons, especially AI infrastructure projects. We've also broadened broadened our aperture there to include partnerships like the one we announced with BlackRock yesterday. And we'll continue to be thoughtful about evaluating the appropriate different sources of capital over time as we evaluate future projects.
Your next question comes from the line of Mark Shmulik with Bernstein. Please go ahead.
Yes, thanks for taking the question. Mark, everyone's got a story of, kind of someone coming back from Silicon Valley, deep writing code, building agents with AI, and then they head home, and they kind of tell their parents they're using AI wrong. It's just kind of like a glorified search tool. Consumer behavior is always pretty difficult to predict, but kind of reading your op-ed on AI for everyone, how do you think about whether consumer adoption can close this AI utility gap? Like, are we on the cusp of something kind of breaking through, or do we just need to be a bit more patient? Thanks.
Well, I think that some things have already broken through. And I think one of the interesting things about AI compared to other technologies is that every year or so, and the cycle may accelerate, but every year or so you get new capabilities that create new possible product lines. So there's obviously the AI assistant market for consumers where that's what we're doing with Meta AI, and then there's the other products that that competitors have in that space. And then in the last year, I think the coding agent market has really grown very quickly. And that's the first real agentic market. And I think that there's a number of reasons why coding is first, right? You have technical customers who are willing to do the work to make it work. Coding is an inherently digital and closed loop activity. So it's sort of, in some ways, it is somewhat of kind of an easier system to train on. But our bet is that, or one of the bets here that we're making is that we think that consumer personal agents is going to end up being an extremely important and massive market. I think that it's extremely unlikely if you look out 5 years from now, for example, that whatever period of time you want, that you don't have billions of people with a personal agent that understands your goals and that is just working on your behalf 24/7 to achieve your goals, and whatever the domain is that you care about, whether it's helping you with your health or your hobbies or your personal finances or your productivity and running your home better, or improving and enhancing your relationships, helping with your career, helping like just all these different things. This is like a very, very deep set of use cases. But like you said, I think that building for consumers is a little bit different than building for developers. If you're building for consumers, especially if you're trying to build something that isn't used by millions of people, but is used by billions of people, it needs to just work, right? It needs to be simple. And I think a lot of what we see with these agents today, a lot of the kind of proto agents, is it takes a bunch of fiddling. You have to get into a terminal to get it set up. You get a use case going. It kind of seems magical, but then maybe it breaks down over time. And I think that the companies that can deliver the personal agents that just work, I think that this is going to be one of the next major opportunities in AI. And we are very excited about that, in addition to what we're doing with Meta AI, in addition to what we're doing with business agents, in addition to all these other things, while also developing the models that we think are going to continue to advance new capabilities to create new product lines as well. So this is why we're very optimistic. Now, I get, we're going to ship this at some point soon, and that's going to be very exciting. And we haven't done that yet. So, so this is, there's kind of only so much that I can say on an earnings call about this. But I think this is a very large opportunity, and one that I think is almost inevitable that someone does. And I think it really plays to Meta's strengths as a company. We build consumer products that reach billions of people. We're great at, once we get something working, scaling it to a large number of people. And we're good at building the infrastructure to be able to support these intensive applications. So I feel very good about this. I kind of understand that we need to deliver it for our community, and that's what we're very focused on.
Your next question comes from the line of Doug Anmuth with JP Morgan. Please go ahead.
Great. Thanks for taking the questions. One for Susan, one for Mark. Susan, you talked about how LLMs are increasingly capable of delivering ranking and recommendation gains. Can you just talk more about the roadmap here and how far along you are in just leveraging better models and more compute? And then Mark, just in terms of the number of offers to monetize your compute externally, you also at the same time are purchasing capacity from a number of third parties. So just hoping you can help us understand some of the differences here. Is it just timing and stopgap issues, or is it training versus inference and leveraging the chips that are best suited for each? Thanks.
Thanks, Doug. I'll take that first question about where we are on the recommendations roadmap. First of all, we certainly see further headroom to continue improving recommendations over the rest of the year and into 2027. And we expect that will help us drive additional gains on both engagement on Facebook and Instagram. A couple things I would highlight. First, we'll continue to make recommendations even more personalized and relevant to user interests. And that's in part by advancing our recommendation models and architectures to further capture user interests more precisely and respond faster to what people care about in a given moment. Our AI investments are going to play a significant role in delivering on this vision, including the expansion of LLM-based content understanding to develop a deeper understanding of posts and creators that people value, to capture user interests more precisely and respond more quickly to what they care about in the moment, and using AI to surface high quality, fresh, and trending content and reduce the share of low quality content. Second, we're continuing to improve our data infrastructure to allow our models to train on more data and leverage that data more effectively. We're adding more detail to how we describe content that users have engaged with in the past and enriching past user interaction sequences with more granular content. That allows our models to more precisely learn which engagements are more or less valuable to users. We're continuing to scale up both the length of user interaction sequences we use during training, as well as the complexity of our model architectures across Facebook and Instagram to take advantage of the larger data sets. And then, we've already made significant strides leveraging LLMs for content understanding. We're going to further incorporate them into both our recommendations and content policy enforcement stacks, given their capability to more deeply understand content. And I would say, broadly, I think we're very optimistic about that body of work. We've also invested in using LLM-based agentic approaches to transforming our recommendation system, and we grew the number of launches from our ranking agents this half. That also helps make our engineers more productive, and that's another path that we're very excited about as well.
Yeah, okay. I can answer the second part of that. I think your question was about how we think about offers that we're getting to sell the compute, but then we're also buying the compute. Look, the high level observation is that there's just nowhere near enough compute for all the demand. So that is why we see that, like, basically we are getting a large number of offers for the compute that we have, but also we have a lot of internal uses that we think are going to be quite valuable. Now, in terms of running the business, obviously a common trade-off that we need to make is around how much do you monetize something today versus develop future assets for the future. And I think that it's always a portfolio, right? It's not like you don't want to only do long-term things and and not kind of prove the markets out that exist in the near term. But I also think it would be foolish to basically just sell all of the compute and take a short-term profit. But when you have the opportunity to build intelligence on top of it, which will be a kind of a multiple and that compounds the value of the compute on top of that. So I think the answer is what we're doing, which is to basically use a lot of our capital to build out compute, having confidence that we have the ability to monetize the compute directly when that makes sense, but also knowing that we have quite a number of different use cases to monetize the intelligence on top of the compute, including the enterprise cases that we talked about, and including some of the consumer and cases that we talked about, and including just the core business, which is not even necessarily new products that we haven't talked about, but just in terms of using that to be able to further add intelligence and improve the ranking and recommendations and ads and the core services. So I think all of that is true, and it creates this dynamic where there is a lead time where we're investing in building out these data centers now. They come online at some point in the future. You obviously are not getting value out of them until they're online. But we basically see a very large demand for all of this and want to go maximize the opportunity to build out all of these different businesses.
Your next question comes from the line of Justin Post with Bank of America. Please go ahead.
Great, thanks. Mark, you hired the senior leadership of your AI labs about a year ago. Could you just give us your thoughts on how the lab's performing? And do you think the street will really see an uptick in product velocity as far as models or chips or other things coming forward? And then what kind of sustainable competitive advantages do you think the lab is building? Thank you.
Yeah, so I mean, I'm quite happy with the trajectory that we're on. We've released a few models that I think are quite impressive on our early scaling ladder, and as I've said, we're in the process of scaling much larger and more advanced models, and we're excited about those too. I think that there's the intelligence aspect of this, and then there's the data aspect of it, and I think it is true that in any kind of product category that you want to go into, there's going to be some kind of flywheel where you learn from the behaviors and how people in that community are using the product. So in kind of the better that you can do there, the more feedback you get, and then that inevitably makes the products better. So I think this is a field where people understandably are obsessed with intelligence, but the data and the knowledge part of it to serve people well is really important. If you're talking about personal super intelligence, then obviously having a very clear mental model of everything that is going on in the person's life and their goals is going to be a very important aspect of that. And certain companies start with different advantages in different markets and different parts of that, but also I think part of the reason for working on a number of these different things up front is that, first of all, the technology is general. So when you build the intelligence out, it can apply to a number of different uses. But then you want to invest in building up the flywheel on them, because I think that that's how you build the sustainable advantage over time. But I think that we've definitely shown at Meta that when we have a product in a format that works, I would go as far as to say that I think we're probably the best company in the world at scaling those experiences to billions of people. So I feel quite good about the personal agent work. I feel very good about the business agent work, where we kind of already have our base of advertisers and small businesses that we serve, and the ability to scale that out and roll it out around those. I think that those are durable advantages, as well as the data flywheels that we're building on them. And then, obviously on the research side, you want to build good culture. I mean, this is just kind of the simple stuff, but it's, I think that it's, you just want to make sure that you're building the team in a way where you're managing things well and kind of consistently with low drama compounding over time. And that's sort of the goal that you aspire to. And I think if you can do that well, then that is hopefully, may not be kind of a clear mathematical explanation of something, but I think that that's kind of how business works. So yeah, that's what we do.
Your next question comes from the line of Ross Sandler with Barclays. Please go ahead.
Yeah. Hey, Mark, sticking with the comments on the AI lab. So Muse Spark 1.1 is pretty close to the Pareto frontier, but it's at the lower end of the intelligence spectrum, or lower cost end, I should say. And it sounds like from your last answer, you think it's important to compete at both the lower cost end and the more expensive performant end. Could you just talk about that a little bit? And then the leadership of your lab has also talked about going back into open source, kind of where you were a couple of years ago. So how does that fit into the strategy and all this discussion around monetization of AI products and models? Thank you very much.
Yeah, so I mean, just to get into the kind of scientific process on this a little bit, basically training large models, at each stage of training a large model, you see novel behaviors. So basically the way that you want to do this is you build up from training smaller models to building larger models. And the models that we've released so far are based on, they're a certain scale in climbing up the scaling ladder, and we're continuing to scale larger models. So I think for Muse Spark 1 and Muse Spark 1.1, I think that they are very impressive models for the scale of the model, the kind of stage of development of the lab, and I feel quite good about them. Now we want to have models that are more advanced as well, and that's why we're scaling larger models, and that's why we're building out a bunch of the research infrastructure around that. But at the same time, we also want to have good, more efficient models that will be a lot of what we serve to consumers at scale. Right? If you're serving billions of people, you want the ability to have more advanced models for things that are very hard problems, and you want the ability to serve the vast majority of prompts from simpler and more efficient models. So I think both are going to be very important. The efficiency really matters, but I also think that we want to be able to solve the hardest problems for businesses and customers around the world. So we care about both of them. On open source, I think we have always felt like open source was an important part of the ecosystem, and it's good for the world, and it creates its own feedback loops that are positive for us around getting the community invested in our infrastructure stack and our work and contributing improvements. But we've always basically said that we were going to do a mix of open and closed, and that continues to be true. Now, in ramping up Meta Superintelligence Labs, there in some ways, actually counterintuitively, it takes some more work to do open source models because you're not necessarily, if you're doing something as a closed system that you're only building for your own use cases, it can be a little more jagged. Whereas if you release it as open and it's going to be used for a lot of things, you want to make it more well-rounded. And I just wanted to make sure that the MSL team was uninhibited in building out the most intelligent models that we could. And we expect that we will get back to releasing some open source models at some point soon. But like we've always said, we're not dogmatic about this. We think open source is important. We want to contribute to that ecosystem. We plan to do a combination of open and closed models.
We have time for one more question, and that question comes from the line of Ken Gawrelski with Wells Fargo. Please go ahead.
Thank you. Two, if I may, please. I just want to maybe, Mark, just touch on the last point again around open weight models. There's been a lot of discussion. You've weighed in on the topic. Why or why not does that change Meta's view of developing closed proprietary frontier models? What is there an opportunity if open weight models proliferate that you don't have to develop your own frontier models? So that's question one. And the second one, a clarification, if I may, for Susan. You noted that in your prepared remarks that you plan to maximize 26 and 27 capacity. Is that a demand or a supply comment? Meaning, are you suggesting that Meta plans for internal use of all the capacity built through 27? Or are you saying that you will evaluate 28 and beyond builds based on demand for Meta products and services? Thank you.
I can take the open source question. Let's see. So, do we? Or is it basically the question is, do we think that because there are some open weight models that we can just rely on those? I mean, right now the open source models are not as strong as the frontier models, so no is the basic answer. And then there's also just always the perpetual both policy debate and question around other companies' actions and whether that's actually a thing that a company like Meta can rely on. And I think that that's very tricky. So I think on both fronts, we believe we're going to be able to do better work, and we think that there's some risk in that reliance. I don't believe that is the right thing to do. I think that we're a company that if you look at Meta from take a step back on this, a lot of people view the surface layer of we build some social media apps and we have an ad business. We are really a full stack technology company. We built our own data centers, our own infrastructure, our own chips, our own low-level software. When we got started, and I my background in engineering, I wrote a lot of the systems code. A lot of the reason why Facebook worked was because it just worked, right? It literally worked when other social networks did not work fast and efficiently. And I think we just have the ability to build things that can be more personalized, more optimized, more efficient. Some qualitative experiences are just not even possible for others to build because we go all the way down the stack. And it just seems to me pretty clear that having kind of sovereignty over building your own models is going to be an important part of that stack going forward, which is why it is important for Meta, but is also important, is also why other people care about open source and why open source matters overall. Because like other companies, even if they don't have the ability to build these models, do not want to have to just rely on a small number of closed labs. Like that there's a very important place in the world for there to be open source models. And to be clear, that doesn't take away from the API opportunity or any of the things that I'm talking about, because someone still needs to run the models and run inference on them and be able to kind of run those models efficiently and have the compute to do that is going to continue to be a source of business advantage. So I don't really think that these things are necessarily at odds. But when I look at like, you know, what a lot of discerning customers and companies are going to want around the world, they're going to know that they're going to want to know that they have control of their destiny and that they can trust the models that they're using and that their data is safe and that they're not sending it to competitors and all that. So I think open source is going to be important, but I think for us also building the models is going to be a critical part of it. It also, you know, for what it's worth, and I know that like the models all get evaluated on like a common set of evals and they get chalked up to like, okay, some models within like a couple of points of another model or whatever, but they all really do have different combinations of skills, kind of like people, right? It's like people have spikes in certain areas and have different personalities and are better and worse at different things. And if you're trying to build personal super intelligence for people, or you're trying to build a business agent for small businesses, that needs to have potentially some different skills than what the other labs are tuning. And just like being able to do the full stack work on like Instagram recommendations or on our ad system is how we've gotten the results there over time. I believe that building the kind of full stack model is going to be a lot of the advantage over time in how we build personal super intelligence agents, business agents, all these different use cases for all of the different customers that we want to serve. So in addition to the distribution that we have and the ability to reach all these people and scale products that work, I think this is a lot of the durable advantage, is that you build something that is kind of specific to that use case and excellent at those use cases. And I mean, look, I get that this is a big investment and it's a big bet. We see the technology working. We're happy with the trajectory of the lab. I'm excited about the products that are coming, and we believe that this is going to be a big thing. So, I mean, I get that this is sort of a big bet across the industry. My personal bet is that the people who invest in this are going to be rewarded and feel very good over time.
Ken, I'll just quickly answer your second question. When we refer to focusing on 2026 and 27 capacity, there are really two factors. One is we are today and expect to be in the sort of foreseeable future demand constrained. And that really includes our core business too, where there are, you know, we still have numerous ROI positive places that we would put compute toward if we had it. And the second, of course, is just the uncertainty over long-term constraints on building capacity. And we talked about some of the sort of the need to build out more of the supply chain earlier in my comments. So, you know, I think beyond 27, when we look into 28 and further than that, the world is going to evolve a lot. Our own internal demand will evolve. We'll have turned over a lot of cards by then. And so when we think about planning today for 28, we're really focusing on flexibility. That's just giving us kind of the ability to have land and power, but to really make the actual decisions about buying chips and other big ticket items further in the future. So for now, I think we know we have a lot of good use cases for capacity in 26 and 27, and that's really what we're building toward.
Great. Thank you for joining.
Okay. Jose, any quick comments? Because I have Microsoft's call in my in one ear. They're not just reading the prepared remarks, so we have a little bit of time to talk about Meta before we jump into the other one.
Yeah, I mean, a few things that really caught my attention. First, Meta is just still very much bullish on building AI CapEx and AI infrastructure, right? They mentioned that, sure, they could sell this. And it's interesting. I wonder if the market is also punishing it, because it doesn't seem like it's that excited about selling compute. Mark Zuckerberg says that's the opportunity if they need to, but they see a lot more value in their internal AI infrastructure and eventually selling intelligence like they do with the API that they have right now. They have better margins of that. They also mentioned that some people are here saying that it doesn't sound good for 2028. I actually think they said stuff that sounded really well for 2028 and beyond. A quote that I pulled was, "The industry has underbuilt historically for the wave of AI adoption, making existing capacity, including our own, extremely valuable. Longer term, the supply chain needs to build out to support the capacity that we anticipate we and others will need for AI power experiences." So to me, what Meta is just preparing us is 2027, 2028, we're going to continue to see CapEx growth. The story is still pretty much here. Mark Zuckerberg also denied any fears of open source models really creating a headwind into the overall industry. He says you still need pretty much frontier models. So while the market might be down, while the market might hate it, I am actually in line with what AI is going to do. And I think Mark actually has a plan to be successful in this AI race.
Yeah, I don't know. It does seem like they're trying to send a message like we are careful with the building, but on the other hand, we are not done yet building, right? Because otherwise they would have said, "Oh yeah, 2027 significant increase, 28 probably also as well." But here they're like, "We're looking at 26, we're looking at 27. We'll plan accordingly." All in all, again, it's the same story time and time again. It's like every quarter is the same. It's like we are investing, our core business is doing better than expected. Now finally we have a good model. We're shipping new products. The new model allows us to ship more products faster, better products, new apps, etc., etc. So it seems like it's the same message, yet Wall Street doesn't receive it.
And I think they even went further this earnings call. I feel like they're always telling you how it's improving, but I think this time they really went in depth of like, hey, because of this LLM, this is what we did. And I think historically they would just give us, oh, we had like an ad impression growth by X percentage. But I think in this call they made they made a lot more points behind it. And obviously we can't cover it all here, but I think they really kind of walked hands. They really walked your hand and to cross the road to understand how AI is innovating their ad business. So I don't know. People were saying it wasn't a good call. I actually thought there was a lot of informations about the AI story and their AI progress.
I mean, people need to understand like Meta's earnings calls are, especially over the last 2 years, have been more about just them trying to talk about the core business, say that the core business gets a lot of benefits from this AI build out. They show the performance and then they just talk about the future. And that's about it. I don't know what people are expecting to hear from them. Like I said before, I didn't expect to hear any numbers with regards to the subscription business, etc., etc. But it does seem like they are speaking now more about enterprise solutions, etc., etc. So at one point we will get more details of the business when those business segments become actually bigger, right? Because what's the point? Oh, we generated $2 million. I don't really care when you're generating tens of billions of dollars with your advertising business, which I believe is the fastest growing ads business right now. So still not bad. But yeah, for now, it's, I guess, another quarter of the market choosing more pain while Meta continues to execute, build, spend, grow, and be at the core quite profitable. By the way, I don't think they bought back any shares this quarter, which is interesting.
Yeah. I'm just curious to see like what will be the turnaround story for stock prices to shift, right? It's just like, what is the market expecting right now? Like I think that's such a fun thing to try to guess. It's like, what does the market want and what would create the shift? And I do think, at least from the earnings perspective, someone posted on X that it had to do with some litigation stuff that caused the hit in some of their earnings and something else, but all of us where it was like one time of impact. And I think even management kind of stated that as well, that even without this one time impact, earnings per share would have been up.
Repeat that again.
That I think management mentioned that earnings per share were down. It was mainly because of
Yes.
litigations and some legal issues.
Yeah.
And if they didn't have kind of those legal issues and some other stuff, we would have seen earnings per share not at these levels.
Yeah. Of course, there are also, I mean, expenses, etc., but there is that one-time big impact, and they did talk more about legal stuff going on right now, where we're going to have, I think in August, there are a couple of things that could happen for the business. But yeah, to answer when will this flip, I don't know. We've had, if I zoom out, someone said my prices are not correct. I think the prices are correct, but it is a 1 minute chart. So I guess you'll have to wait 60 seconds to get an update. But we've had sell-offs before. Like even this year, we've had a sell-off at the start of the year that lasted a month or so, right? Across the board. And then suddenly it bottomed. What happened there? I don't know. I mean, at the end of March, we had that so-called ceasefire stuff, but that didn't hold, and yet the market still went higher and higher. Right now, what needs to change sentiment-wise? Honestly, I don't know, because someone said in the chat, capex increase bad, capex not increasing too much also bad, companies growing and becoming more profitable also bad. Like what's going to be good in this market? That's a very good question.
Yeah, and I think we're gonna join Microsoft earnings in just a few minutes. I think we just want to see if there are any questions here. If not, I think we'll be there.
Yeah. Let's see if I can find.
I swear the market needs to talk to a therapist. I agree with that.
Pre-market. No, there is nothing yet. But for now, for now, it's just Satya talking about prepared remarks. Nothing.
Okay. Nothing new.
Too crazy. Let's see if there is a name that's actually not down. So Hood flipped is now down 4.7%.
They're investing in AI capex too.
actually, yes, but I don't know if that's the reason, but okay. All the rest, the usual suspects are down 2-3%. Again, it's pre-market. We'll see what happens tomorrow, because even today, most of these names were down significantly. Is there anything that's green? Snowflake is green. That's it. So software. So Snowflake sort of. Snowflake up. Where is Adobe?
Yeah, and I'm not gonna lie. I think this is one of the earnings that I don't mind. I'm gonna most likely read again tonight. I think there was a lot of information in this one, just like the in-betweens of like open source models, the in-betweens of the compute market, the in-betweens of selling intelligence, and what are some of the new technologies coming. I think even Mark Zuckerberg mentioned that the past, like we've had like a new AI evolution once a year, and he thinks that's going to accelerate, where we're going to have multiple events happening in the year that can overall go into different markets as well. So I want to read that transcript one more time.
Yeah, there are some things that he did not want to talk about during the call. It's probably because there is an event coming up or something. But yeah, I mean, if you don't plan on holding these names for more than 2 days, then I guess it's not for you. This is AI is moving quickly, but you got to give these companies a little bit of time. This is not why are we not at $1 trillion for this name and that name? I think a year from now we'll be in a much better situation. Let me pull up Monsieur Nadella.
In Biz Apps, we have been reinventing Dynamics 365 for an agent-first world. We are exposing over 650,000 MCP actions across sales, finance, supply chain, HR, and customer service so that agents can now access business context and take action using the same data models, rules, permissions, security guardrails, and audit trails as any application user. And we are also moving from seats to seats plus consumption model. Customer service is at the forefront of this transformation with usage-based credit consumption in this category up 4x quarter over quarter, with customers like Northern Trust using our tools to drive proactive intelligence. When it comes to developers, GitHub Copilot now has 50 million users. This quarter, we introduced usage-based billing and have continued to see business and enterprise seat growth and also significant consumption revenue after the new model went into effect. Copilot revenue accelerated over 60% quarter over quarter. All up, GitHub now has 225 million users as organizations across every industry, including over 90% of the Fortune 500, choose GitHub for their AI-powered development. The agentic era is being built on GitHub. Every major coding agent runs on the platform, and 1 in 3 pull requests on GitHub now involves an agent. In security, we are helping customers both secure their AI deployments and use AI to strengthen their security posture. To date, Purview has audited over 50 billion Copilot interactions to meet compliance obligations, up nearly 360% year over year. And earlier this week, we introduced Project Perception, a complete multimodal agentic security system that brings together teams of agents to simulate attacks, investigate threats, and drive remediation. As Perception moves beyond private preview, we expect to bring it to customers through a consumption-based offering. In healthcare, we are on pace to automate over 100 million patient encounters this calendar year, including 28 million this quarter, up 2x year over year. Mass General Brigham rolled out Dragon Copilot to over 4,000 providers, and after a study found ambient AI reduced burnout by 21%. And in science, Microsoft Discovery, now broadly available, provides a comprehensive platform for building and governing agentic workflows for science and engineering. Early customers include BHP, GSK, Pacific Northwest National Lab. Across both our high-value agentic experiences and the AI platform and infrastructure, we are focused on helping customers turn AI into measurable outcomes. The most comprehensive and valuable data in the world is inside each of the customer tenants, and therefore there is a tremendous opportunity to turn customers' workflows, domain knowledge, and accumulated judgment into AI systems that learn and improve with every usage. To help customers capture that opportunity this month, we launched Microsoft Frontier Core, the largest outcome-driven engineering organization in the industry. We will embed 6,000 industry and engineering experts with customers to co-design, co-innovate, and continuously improve AI systems at scale. We've been testing this model over the past year, completing over 330 projects across 164 customers, including many of the world's leading companies across industries. For example, our FDE teams worked with Novo Nordisk to build an agent that helps analyze clinical data while meeting its strict compliance requirements. And we partnered with LSEG to embed AI into LSEG Workspace, helping finance professionals ask complex questions and quickly find answers across structured and unstructured financial content. Finally, let me talk about devices and consumer. When it comes to Xbox, we are making the necessary decisions required across our content portfolio, platform, and operations to reset the business for long-term growth. We have the best IP in the industry and talented studios around the world, and believe we can bring these strengths together and expect to return the business to growth in fiscal 2027. In Windows, we are investing to ensure that it has the best quality and fundamentals while also ensuring it's the best place to run secure edge AI. We see significant opportunity for Windows to become the offload for unmetered intelligence, combining powerful on-device compute with enterprise-grade security. In search and advertising, Bing and Edge have both taken share for 5 straight years. And LinkedIn continues to see strong engagement across the platform with double-digit member growth for the 5th consecutive year. Recruiters at over 20,000 companies are now using our AI-powered solutions to reduce time to hire and improve candidate matching. Seats increased to 140% quarter over quarter. In closing, I'm energized by the opportunities ahead. I've never been more confident in Microsoft's opportunity to drive durable long-term growth and ensure the benefits of AI flow broadly. With that, let me turn it over to Amy to walk through our financial results and outlook.
Thank you, Satya, and good afternoon, everyone. This fiscal year, we delivered over $331 billion in revenue, with growth accelerating to 18%, driven by strong demand across both the Azure platform and our first-party AI applications and services. Operating income growth outpaced revenue growth, increasing 21% to more than $155 billion, as we invested in long-term growth while continuing to expand operating leverage. This quarter, revenue was $90 billion, up 18% and 17% in constant currency. Gross margin dollars increased 15% and operating income increased 18%. Earnings per share was $4.74, an increase of 23% when adjusted for the impact from our investment in OpenAI. And FX was roughly in line with guidance. Several discrete items impacted our financial results in the quarter when compared to our forward-looking guidance provided on our April earnings call, resulting in a benefit of 27 cents on diluted earnings per share. These included a $3.2 billion gain from our investment in Anthropic and lower than expected expenses related to the voluntary retirement program, which were partially offset by severance expense and impairment charges in Xbox. When adjusting for these items, we exceeded expectations across revenue, operating income, and earnings per share due to strong demand and execution in the quarter. Company gross margin percentage was 67%, down year over year, driven by sales mix shift to Azure, as well as continued investments in AI infrastructure and growing product usage, partially offset by ongoing efficiency gains, particularly in Azure and M365 Commercial Cloud. Operating expenses increased 10%, driven by continued investment in R&D compute capacity, talent, and data to support product development across the portfolio. G&A growth was impacted by a low prior year comparable, as well as some of the discrete items mentioned earlier. Operating margins increased slightly year over year to 45%. Total company headcount declined 2% year over year. When adjusted for the impact of our investments in OpenAI, other income and expense was $2.8 billion, driven by the gain on investment in Anthropic noted earlier. Capital expenditures were $41 billion, including the impact from higher component pricing, as noted in our guide. Roughly two-thirds of our CapEx was for short-lived assets, primarily CPUs and GPUs, as customers increasingly build solutions that leverage both AI and non-AI infrastructure. The remaining spend was for long-lived assets. This quarter, total finance leases were $5.6 billion and were primarily for large data center sites. And cash paid for PP&E was $35.8 billion. Cash flow from operations was $55.4 billion, up 30%, driven by strong cloud billings and collections, partially offset by an increase in operating lease payments. And free cash flow was $19.6 billion, reflecting higher capital expenditures. And finally, we returned $10.2 billion to shareholders through dividends and share repurchases, bringing our total cash return to shareholders to over $43 billion for the full fiscal year. Now to our commercial results. Commercial bookings grew 18% when excluding the impact from OpenAI, driven by strong execution in our core annuity sales motions and reflecting broad customer demand across geographies and customer segments. Bookings increased 10% and 11% in constant currency when including Azure commitments from OpenAI. Commercial remaining performance obligation grew 84% to $678 billion. All sequential commercial RPO growth was driven by commitments from customers outside of frontier model companies, and RPO increased 25% when excluding OpenAI. RPO, including OpenAI, has a weighted average duration of 2.3 years, and roughly 30% will be recognized in revenue in the next 12 months, up 37% year over year. The remaining portion, recognized beyond the next 12 months, increased 112%. Microsoft Cloud revenue was $59.3 billion and grew 27%, reflecting strong demand across Azure and our first-party AI applications and services. And for the full year, our cloud revenue surpassed $214 billion, with nearly 90% from customers outside of frontier model companies. Microsoft Cloud gross margin percentage was better than expected at 65% and down year over year, driven by sales mix shift to Azure, as well as continued investments in AI infrastructure and increased product usage, partially offset by ongoing efficiency gains noted earlier. Now to our segment results. Revenue from productivity and business processes was $37.8 billion and grew 14%. M365 commercial cloud revenue increased 16% on adjusted basis when normalized for the prior year comparable that benefited from 2 points of in-period revenue recognition. And on a reported basis, revenue growth was 14%. Building on our Copilot momentum from Q3, net paid seat adds more than doubled sequentially, with paid seats now over 30 million. Premium offerings, including Copilot, E5, and early traction in E7, drove ARPU growth this quarter. And paid M365 commercial seats grew 6% year over year, with installed base expansion across all customer segments, though primarily in our small and medium business and frontline worker offerings. M365 commercial products revenue increased 19% ahead of expectations, driven by large, long-duration M365 contracts that resulted in higher in-period revenue recognition from the Windows commercial on-premises component. M365 consumer cloud revenue increased 24% and 22% in constant currency, again driven by ARPU growth. And M365 consumer subscriptions grew 7%. LinkedIn revenue increased 12% and 10% in constant currency, primarily driven by marketing solutions. Dynamics 365 revenue increased 13% and 12% in constant currency against a strong prior year comparable. Bookings growth at ERP remains healthy, while CRM continued to moderate with longer sales cycles. Segment gross margin dollars increased 14% and 13% in constant currency, and gross margin percentage decreased slightly with increased M365 Copilot usage as we continue to invest in product quality and drive further efficiency gains. Operating expenses increased 11%, primarily driven by the shared R&D investments mentioned earlier. Operating income increased 15% and 14% in constant currency, and operating margins increased year over year to 58%. Next, the Intelligent Cloud segment. Revenue was $39.3 billion and grew 32% and 31% in constant currency. In Azure and other cloud services, revenue grew 43% against a prior year that included accelerating growth. Customer demand continues to exceed available capacity. Revenue growth was ahead of expectations, driven by efficiency gains across our CPU and GPU fleet, as well as process improvements to enable earlier delivery of new capacity. That additional in-quarter capacity for Azure was quickly monetized. Results also benefited from stronger than expected GitHub Copilot consumption following the June business model change to align pricing with usage and value. In our on-premises server business, revenue was relatively unchanged year over year and was down 1% in constant currency. Results were ahead of expectations, primarily driven by renewals with higher in-period revenue recognition from the mix of contracts. Segment gross margin dollars increased 24% and gross margin percentage decreased year over year, primarily driven by sales mix shift to Azure, as well as the continued scaling of our AI infrastructure ahead of growing demand, partially offset by ongoing efficiency gains in Azure. Segment gross margins were also impacted by growing GitHub Copilot usage, though margins improved through the quarter with the June business model change to usage-based pricing. Operating expenses increased 10%, driven by shared R&D investments noted earlier. Operating income grew 31%, and operating margins, with a strong focus on efficiencies and investment returns, were relatively unchanged year over year at 41%. Now to more personal computing. Revenue was $12.9 billion and declined 4% and 5% in constant currency. Windows OEM and devices revenue decreased 7%, and Windows OEM decreased 5%, driven by lower PC market demand and a high prior year comparable that benefited from Windows 10 end of support. Results were ahead of expectations as OEM and channel partners continued to build inventory given increasing component prices. Search advertising revenue ex-TAC increased 10% and 9% in constant currency, with growth driven by higher revenue per search across Edge and Bing, as well as higher volume. The growth was impacted by third-party partnerships. And in Xbox, revenue decreased 10% and 11% in constant currency. Xbox content and services revenue decreased 10% against a prior year comparable that benefited from strong first-party content performance. Segment gross margin dollars decreased 2% and gross margin percentage increased year over year, driven by lower amortization from the Activision acquisition. Operating expenses increased 8% and 7% in constant currency, driven by the continued investments in shared R&D noted earlier, as well as impairment charges in Xbox. Operating income decreased 14% and 15% in constant currency, and operating margins decreased year over year to 21%. Now, before I move to Outlook, effective at the start of FY27, we are extending the estimated useful life of our data centers and office buildings from 15 to 25 years, reflecting our operating history and expected use of these assets. The impact of this update is reflected in today's guidance. This change affects only the timing of future depreciation and is expected to have a minimal benefit to FY27 operating income. The greater impact is on capital expenditures, as more of our future data center leases will shift from finance leases to operating leases as a result of this update. Finance leases are included in capital expenditures, while operating leases are not. Outside of this useful life impact, our calendar year 2026 CapEx investment expectations remain unchanged. However, the shift from finance to operating leases adjusts our expectation to approximately $175 billion. Now, moving to our outlook. Let me start with some full-year commentary for FY27. First, some reminders. In both M365 commercial products and server products KPIs, we are lapping higher transactional purchasing from the timing of product launches and expect revenue from both to decline in the mid-single digits for the full fiscal year. Growth in Windows OEM and devices will be impacted by lower PC market demand as higher component costs increase device pricing, a prior year comparable that benefited from Windows 10 end of support, and elevated inventory levels. As a result, we expect revenue to decline in the high teens for the fiscal year. Moving to FX. Assuming current rates remain stable, we now expect FX to decrease full-year fiscal revenue growth by less than 1 point, with no meaningful impact to COGS and operating expense growth. At the company level, with strong commercial momentum, we continue to expect another fiscal year of double-digit revenue and operating income growth. Operating expenses should grow in the mid to high single digits, reflecting continued investment in R&D compute capacity, talent, and data. And we expect FY27 capital expenditures will grow year over year, given demand signals across our portfolio. Even as we invest to meet growing demand, full fiscal year operating margins should be down less than a point. In addition, we expect to remain free cash flow positive in FY27. And finally, we expect our FY27 effective tax rate to be approximately 20%. Now to the outlook for our first quarter, which, unless specifically noted otherwise, is on a US dollar basis. Based on current rates, we expect FX to decrease total revenue growth by less than 1 point, with no meaningful impact to COGS or operating expense growth. Within the segments, we expect FX to decrease revenue growth in productivity and business processes by roughly 1 point, and intelligent cloud by less than 1 point. There is no meaningful impact in more personal computing. Starting with our commercial business. In commercial bookings, when adjusted for the impact from OpenAI, we expect healthy growth on a growing expiry base, driven by strong execution across our core annuity sales motions. As a reminder, the significant OpenAI contracts signed in the prior year will result in some quarterly volatility in both bookings and RPO growth rates. Microsoft Cloud gross margin percentage should be relatively stable quarter over quarter. Now to segment guidance. In productivity and business processes, we expect revenue of $36.7 to $37 billion or growth of 11 to 12%. In M365 commercial cloud, we expect growth of approximately 16% in constant currency on an adjusted basis, which normalizes for the prior year comparable that benefited from 1 point of in-period revenue recognition, or 15% on a reported basis. Sequential growth from our momentum in Copilot, E5, and E7 is mitigated a bit by the lower ARPU new seat adds in frontline worker and small and medium business SKUs. With the premium SKU momentum and the increased monetization opportunity from adding usage-based billing products alongside per-seat licensing in July, we expect to see acceleration in M365 commercial cloud revenue growth through this fiscal year. M365 commercial product revenue should grow in the mid-single digits, driven by the timing of long-duration M365 contracts, partially offset by the impact from the prior year comparable noted earlier. M365 consumer cloud revenue should grow in the mid-teens, down sequentially as we lap the benefit from last year's price increase. Growth will again be driven by ARPU and an increase in subscription volume. For LinkedIn, we expect revenue growth in the high single digits. And in Dynamics 365, we expect revenue growth to be in the low teens, relatively stable quarter over quarter, driven by continued growth in ERP, although impacted by the bookings trends noted earlier. For Intelligent Cloud, we expect revenue of $40.95 to $41.25 billion US dollars, or growth of 33 to 34%. In Azure, we expect revenue growth of approximately 45% in constant currency, and we remain focused on delivering efficiencies that help us bridge the gaps we see as customer demand continues to exceed supply. Even with the strong close to Q4, we continue to expect H1 growth to accelerate. And as a reminder, year-over-year Azure growth rates can vary quarter to quarter based on capacity, timing, and contract mix. In our on-premises server business, we expect revenue to decline in the low to mid-single digits with ongoing customer shift to cloud offerings and the prior year comparable noted earlier. In more personal computing, we expect revenue to be $12.2 to $12.7 billion US dollars as we continue to lap strong prior year comparables noted earlier and navigate complex PC market dynamics impacted by component prices and inventory levels. Windows OEM and devices revenue should decline in the low 20s, driven by the market dynamics noted earlier. As in prior quarters, the range of potential outcomes remains wider than normal. Search advertising revenue ex-TAC growth should be in the mid-single digits, down sequentially due to the impact of third-party partnerships. Growth will continue to be driven by consistent trends in revenue per search and volume. And in Xbox content and services, we expect revenue to decline in the mid-single digits. Hardware revenue should decline year over year. Therefore, at the total company level, revenue should be between $89.85 and $90.95 billion US dollars, or growth of 16 to 17%, with accelerating commercial growth partially offset by the impact from the PC market dynamics noted earlier. We expect COGS of $29.6 to $29.8 billion US dollars, or growth of 23 to 24%. An operating expense of $16.8 to $16.9 billion US dollars, or growth of 7 to 8%, driven by continued investment in R&D compute capacity and talent. Operating margins should be relatively flat year over year. Excluding any impact from our investments in OpenAI, other income and expense is expected to be roughly negative $100 million, as interest income will be more than offset by interest expense, which includes the interest payments related to data center finance leases. And we expect our Q1 effective tax rate to be approximately 20%. Next, capital expenditures. We expect CapEx spend will be over $50 billion, including the lease reclassification impact from the useful life update. In closing, in FY26, we delivered accelerating revenue and operating income growth while expanding operating margins. Our execution across sales and product engineering strengthened through the second half of the year. As we begin FY27, we remain focused on delivering products that create meaningful return on investment for our customers, which will result in durable long-term growth for Microsoft and our shareholders. With that, let's go to Q&A, Jonathan.
Thanks, Amy. We'll now move over to Q&A. Out of respect for others on the call, we request that participants please only ask one question. Operator, can you please repeat your instructions?
Ladies and gentlemen, if you would like to ask a question, please press star 1 on your telephone keypad, and a confirmation tone will indicate your line is in the question queue. You may press star 2 if you would like to remove your question from the queue. For participants using speaker equipment, it may be necessary to pick up your handset before pressing the star keys. One moment, please, while we pull for questions. And our first question comes from the line of Karl Keirstead with UBS. Please proceed.
Okay, great. Thank you, Satya. Maybe I'll start away from the numbers and ask if you could spend a minute and elaborate on your opening comments about model choice and the protection of corporate IP. Maybe I could ask this in two parts. First, how material do you think traction could be for open and custom models over the next year or two, knowing that many enterprises might be initially reticent to use open models? And secondly, how exactly does Microsoft benefit from this shift, knowing that you've also got fairly large frontier lab exposure? Thanks so much.
Thank you, Carl. So the way we are coming at this is, at the end of the day, the goal is to have the firm be in control of their own destiny in terms of what I describe as building their human capital and their token capital, right? So at the end of the day, if a firm is a learning machine, they need their own learning machine. And that's sort of really the goal. And the models are an input, not some extraction of the knowledge of the enterprise. But in some sense, you have to really, at the end of the day, every firm is going to evaluate who are the providers who are helping them with their outcomes and their knowledge creation. I think that is now fairly clear, and it's going to become clearer by the day. This is not going to be about, come in and take all my knowledge and benefit yourself, whereas I am not getting anything out of it. So given that direction of travel, we are very, very clear about the architectural sort of design of the platform, which is you've got to keep your harness separate from the model. Now, when the harness will ensure that your memory, your context, all of that is external. That means any given model at any given time is swappable. You should and you can use frontier models. There's no reason not to. But you also can use multiple of them, right? So if you look at some of the stats I gave, it's a great example of how to use the frontier models for what they deliver, how to use low-cost models for what they deliver, and in fact, train your own model when you don't want to use any external model itself, because after all, you have all the outputs, you have all the traces, you have all the context. That's really the enterprise design architecture that we are going to evangelize. We ourselves are using it. Copilot is built that way. GitHub Copilot is built that way. Our security Copilot is built that way. And we want to democratize that design pattern so that every enterprise can use it. And within there will be a mix of open weights, closed weights. And by the way, one of the things that's least talked about is, remember, right, if you look even at the Hugging Face incident, the biggest thing that we should take away from that is you can't sort of depend on any one model. You will maybe need multiple models to even remediate some challenges that get caused by one model. Right? That's the way to think about it, right? Which is you can't be subject to the refusals of one model. So there's a lot more design space here. We talk about the frontier as if it's one thing. The frontier is about every firm having a frontier and the choice, the cost control, and the capability that they need in order to be able to control their destiny.
And I think maybe, Carl, just to add a little bit to the end of your question, which is that it's why it's important that the platform is built, and I think Satya mentioned this in his comments, to be able to deliver the right model for the right job on the architecture called Azure. And so given that we continue to see growing demand, no matter what model is chosen or what model family or whether it's run a model of your own, the Azure platform is quite efficient at delivering that. So think about that infrastructure as being pretty fungible.
Very helpful. Thanks.
Thanks, Carl. Operator, next question, please.
The next question comes from the line of Brent Thill with Jefferies. Please proceed.
Thanks, Amy. Impressive acceleration in Azure, up to 43, going to mid-40s. I guess the questions around the underlying drivers, what you and Satya are seeing in terms of just what's driving this, and many of the questions around capacity constraints. Are we just still in the same environment, or is this Microsoft just executing better given the constraints we're all seeing? Thanks.
Thanks, Brent. First, there are still constraints in the system. I think we've continued to say, I think now for a number of quarters, that demand continues to exceed available supply. And that certainly remains true. You can even see it, I think, in some of the pricing that's occurring in the spot market for assets. So when you think about being able to deliver better, the first thing we focus on, and I tried to talk a little bit about it in my prepared remarks, is efficiency. Being able to get more out of everything that we've got in the fleet. That applies to efficiency gains in the CPU fleet. It's going to be efficiency gains in the GPU fleet. We saw a good work this quarter, in particular from our engineering teams, to make as much of that available as we could. And because of the supply-demand imbalance we've been talking about, when we can make efficiency gains, they are quickly monetized in quarter. And I think that dynamic certainly impacted the quarter positively. I would also say some of the process improvements we've made to make sure both CPUs and GPUs, just the lead time from how quickly we can get things to simplify it tremendously plugged in, was also improved over the past 90 days. And so those improvements, again, are very quickly monetized when we're able to do that. And at the scale that we're operating in terms of across the entire hyperscale fleet, making efficiency improvements that can be quickly monetized does result in acceleration in the quarter. It's part of also what we expect to see and talk about with Q1.
Thanks, Brent. Operator, next question, please.
The next question comes from the line of Mark Moerdler with Bernstein Research. Please proceed.
Thank you very much for taking my question, and congratulations on the solid, really great quarter. Satya, Amy, sentiment around AI remains incredibly volatile, with concerns about oversupply coming, as well as concerns about component pricing increasing, impacting margins. Amy, two related questions. How does Microsoft protect itself if there really is overcapacity and overbuilding of data centers or overbuilding of chips, et cetera? And on the flip side of that, how do you manage through the hardware price increases that we're seeing, the component prices, and that it doesn't just drive you to either massively drive up the price of your offerings or negatively impact your margins? Thank you.
Thanks, Mark. The questions are a little bit related, but I'll start with maybe the first. Currently, the situation is obviously that demand exceeds available supply in a sort of relatively extreme moment. But when you start to think about over the duration, I try to remind people, a lot of the expense, especially you see it in CapEx, you've seen our CapEx really pivot toward what I would call and do call short-lived assets, which really, right, that's CPUs and GPUs that have relatively shorter lead times. And so if the demand environment changes, you just slow down what is, in fact, the largest component, right, and the driver of COGS. The investment into land and data center builds is actually quite flexible, right? It's a smaller percentage of the overall cost structure, and it can be, timing can be changed on much of that, especially on the builds. Or you can stagger the timing of the build out of, as I was saying, some of the GPUs and CPUs that you plan to put in. And so when you think about being able to manage through that, hyperscalers have been doing that for quite a long time in terms of having the flexibility and the understanding of manage those changes in demand. And the other thing is that's important, Mark, is you just have an incredibly diverse book of business by geo, by segment, by industry. And I feel like when you look even at our backlog or what we added in RPO this quarter, it is from the breadth of really the Microsoft product portfolio as well as our customer portfolio. So when you have the ability to late bind some of the more expensive components in short term, you have a big book of business that's flexible. You have a big first-party app business that also uses the capacity that you're building out in addition to your Azure platform. It does allow us to have a lot more flexibility to manage through those. When it comes to the pricing question, I think that's really impacting everybody equivalently in so many ways. What we've been trying to do, of course, at this point is to just make sure that we're doing the best efficiency work we can so we can continue to give customers great value. We're reminding people that, frankly,
the cloud offers tremendous benefits versus having to make these purchases as servers on-prem yourself, where the price increases are even more hard for customers. So the cloud still provides a great ROI in those types of situations. And, we're adding this capacity to your point, but a lot of this obviously is also being sold in newer contracts, and we're able to have the pricing reflect it, but keep value where we, listen, for the long term, you want to have pricing work for customers and for you. And so we're trying to stay focused on that as well.
And if I just add to Amy's comments, I thought Amy captured it well. All of us are reading this 1873 as the book to be read. And so in my mind, I think you've got to get the product shape right. That's sort of a lot of what we're focused on. You have to get the portfolio right. Amy talked about what we're doing, whether it's in Copilot or the super app, bringing all the form factors or all the way to Azure and the agent first sort of primitives in Azure. You kind of have to really get that portfolio to all come together. The mix of customers is super important. You have to recognize the breadth, the geo mix, the segment mix, the workload mix, and you got to really think about all of those when you're even building capacity. And then you got to run an efficient railroad. At the end of the day, you do need to, Amy talked a little bit about even in the last quarter, how we've improved on the efficiency front. It's not something that'll just show up at the end. You have to sort of monotonically work at it. And so we are very focused on all of those. And then we know that there will be, ups and downs of what is the cycle here, but the secular shift is clear, and we're very bullish about us coming with the right sort of mix of business and the right margin structure, and most importantly, with the right value for our customers.
Excellent. Thank you so much.
Thanks, Mark. Operator, next question, please.
The next question comes from the line of Adam Wood with Morgan Stanley. Please proceed.
Hi, good evening. Thanks for taking the question. And also, congrats to me on a very strong end to the year. I wanted to maybe just ask about M365 Copilot. Obviously, very strong quarter there with over 30 million paid seats and a strong acceleration. Could you just talk a little bit about how you're seeing customers move from pilots to broader deployments here? Is this still a pilot-driven motion, or are we seeing a lot more broader deployments? And then when we think about the monetization of the product in terms of additional seats, migration to higher value SKUs like E7, and then consumption, what do you see as the main monetization or the main driver of monetization from here, please? Thank you.
No, thank you, Adam, for that question. So let me start, and then Amy can add. I think, it starts with, again, that product shape. As you can see, even within the quarter, the product shape has changed pretty dramatically, right? So we now have chat, co-work, autopilot, code, all coming to essentially what is going to become this flagship super app that various roles can use it. If you think about even the usage side, that's a place where, again, lots of interesting data there, right? Which is time to usage has, drastically come down. What used to be months is days, right? So when a license is bought to usage. The usage intensity itself has gone up significantly. I mean, we're talking about a usage intensity that's sort of at the same level of what is an everyday communication tool like Outlook or Teams. The second thing I'd say is the overall enterprise wiring of this, right? So it's not like a tool that's isolated somewhere, but it's wired in, whether it is, you brought up E7, right? So it's wired into the governance pieces with Agent 365 so that you have your IT ops, SecOps, FinOps, all wired in, as well as it's all the business processes. So for example, your CRM system, your ERP system, all of them are just skills and plugins that go into co-work. So you're able to take that enterprise-wide workflow and wire it into the super app, right? That increases usage, so it all compounds. And then the other one is the business model. So we now have this per seat business model, and so we also now have the usage business model. So it's seat plus usage. So we're already seeing the ARPU growth that comes from things like E7. But really, as we deliver more value to customer and customer outcomes at the enterprise level, In fact, if I think about historically, Office compared to what Copilot is much more narrow. This is the first time where you really have an enterprise-wide tool which has a both per seat and usage-based pricing. So the TAM is much more expansive. We're going to be very, very focused on driving customer value and then expanding with it.
Yeah, Adam, and I think I talked a little about it in my prepared remarks, but I do think what we've been seeing is over the course of this year, some of the growth in ARPU was from E5 plus the Copilot license that Satya is talking about. We'll see a little bit more from E7. Really has a lot of interesting value in the Agent 365 component in particular, where Satya is talking about. I mean, having SecOps and FinOps, think about, in general, everyone is going to need both observability of token spend and the manageability of token spend for all business processes. And that is what E7 brings. And so I think it was only in market for a part of the quarter, and I think we were quite encouraged by the value customers saw in that SKU. I think we'll continue to focus on that through the year. And then finally, what Satya is talking about is this building TAM that grows through the year. And as I think about that expanding TAM, that's really where we're talking about this usage and consumption growth. And so as more of those experiences get wired in, and as IT gets more involved in that process, it'll be quite, I think, changing in terms of what people think of the M365 capabilities.
It'll be fun for you, Adam. I think one of your colleagues put out an ROIC document. So I took that document to Copilot, which is a PDF, and I said, build me a new sort of a Power BI dashboard, essentially. But here is the thing. It built a rich semantic model that went into my Fabric with one lake that brought all the data in from the external sources. In fact, was current with all the SEC filings of all the Mag 7. And then on top of that, the repo itself is in GitHub, but the artifact is sitting in my Copilot as a site. That, to me, is a classic example of an enterprise-wide workflow. I, as a knowledge worker, could go create a dashboard. The data engineer can go to Fabric and find the artifact. The professional developer can go to the repo and find it in GitHub. And by the way, it's all registered with Agent 365, right? That's a little bit of what Amy is describing as the coming together of a new way to work even, while at the same time bringing IT, security, and manageability of it.
Very helpful. Thank you.
Thanks, Adam. Operator, next question, please.
The next question comes from the line of Brad Zelnick with Deutsche Bank. Please proceed.
Great. Thank you so much for taking my question. Satya, appreciating cybersecurity is so core to everything Microsoft does. The playing field shifted recently with the latest frontier model releases, and this week you introduced Project Perception. Can you expand on what this moment means for your cyber business explicitly, and also what it means for trust in Microsoft more broadly? Thanks.
Yeah, thank you for that question. I think you're right about saying that the entire, I would say, the overall physics of how both what is needed in terms of the cyber product and even the cyber operations, because at the end of the day, you kind of have to sort of transform yourself on both the products, but also how you operate as a company to protect yourself, have changed pretty dramatically. So what we are focused on is first, again, take the same approach we've taken for knowledge work or coding, which is you got to start with an intelligence-first model-forward approach. And so what we launched with Perception is essentially saying, let's sort of really make sure that you have the red team agents that know how to find, constantly are red teaming and finding the vulnerabilities. Then you have the blue team agent that is constantly going and making sure that you're triaging, and the green team that fixes. So you kind of create your own agentic system that's continuously operating to create the cyber defense you need. It definitely feeds off of all the signals, right? Whether it's the defenders, it's the identity intra signal, the defender signal, the network signal, the app security signal, all that sort of helping really do the context so that you can then truly create the protection. The other thing they've also said is, especially in cyber, it becomes critical to have that multi-model approach to sort of the first question that was asked. Not just for cost. In fact, we proved with the M- data in Cyber Gym that essentially you can have Mythos level performance with 50% less cost because of this MAI Cyber Flash 1. And the reason is because 90% of the tasks are done by the Cyber Flash 1 model, and 10% of the tasks you still go to the frontier, right? So this is sort of that mixing of the right model for the right task in what is essentially a pipeline job is a super important characteristic. And so to us, I think this is an important piece. Oh, and the other thing I'd say is from a resilience perspective, right? For whatever reason, if a given model goes away, then you kind of can't be left high and dry. You need to be able to still continue your cyber operations. And that's the other piece. So it's cost and resilience is both an important criteria. And that's what we are trying to build in, whether it's in code, whether it's in cyber, whether it is in knowledge work. We're very excited about perception and what it means, quite frankly, for our security business going forward.
Super helpful. Thank you.
Thanks, Brad. Operator, we have time for one last question.
And the last question will come from the line of Gabriela Borges with Goldman Sachs. Please proceed.
Hey, good afternoon. Thank you. Amy, I wanted to ask you about ROI. And you've given us color on the CapEx side of the equation. You've given us color on the monetization side of the equation. Maybe put those two pieces together for us. When you look at and track ROI on the CapEx decisions you're making today, how does that compare to a year ago? And what are some of the levers that you can still pull, perhaps on the internal silicon side, for example, as a driver of incremental monetization going forward? Thank you.
Thanks, Gabriela. I don't know that, quite frankly, my math has changed in terms of how I do it over the past year. I would say the way to think about it for me is more the confidence in the TAM expansion, the margin levers that we have in terms of both product improvements, then the infrastructure improvements. And we talked about some already on the call today in terms of the levers we have to continue to get efficiencies across both the application part of the stack and then the infra part of the stack. But you're right, we didn't touch on all of the pieces. I think Satya actually commented on a number of them. We still have opportunities, obviously, as we continue to look for the best price performance on silicon, including our investments in first party. The work, frankly, on model diversification also is a margin improvement opportunity, being able to serve the best possible outcome with a more efficient or both efficient in terms of token usage and efficient in terms of cost structure are also margin levers. All of these things contribute, obviously, to your point of increased confidence in ROIC, frankly, of the dollars that we're investing and continue to invest going forward. And, as we think about the mix of the portfolio, being able to have a pretty broad pool across knowledge work, coding, security, then basically the agent layer, I'll call that Agent 365, it's kind of a cheat. But all of that also is an opportunity. And then, of course, what we talked about on the Azure side between model efficiency, silicon and component efficiency, including our investments in 1P solutions there, and just the overall efficiency of running it at a hyperscale. So we have quite a few levers to continue to see improvement that we're focused on. But as Satya mentioned, this is the grind work. This is like every day you just get a little better, and we actually are quite good at that grind and making sure that we can deliver that for customers.
That all makes sense. Thank you.
Thanks, Gabriela. That wraps up the Q&A portion of today's earnings call. Thank you for joining us today, and we look forward to speaking with all of you soon.
Thank you very much.
Thank you.
Ladies and gentlemen, this does.
All right, guys, let me just fix this up as I'm an amateur here. Neo gave me this. Oh, here we go. All right, guys. So we are finished with Meta and Microsoft's earnings call. Neil had to head out. He had an MRI scan scheduled at some weird time. I think it's like 1 a.m. over there. Hopefully everything goes well for him. I think Microsoft stock is up a nice amount. And I do see some people not understand the difference between Microsoft's calendar year and fiscal year of 2026. So they just ended their fiscal year of 2026, right? And to them, they have no real change on guidance for capex, and for calendar year of 2026, they also have no change in capex. I think it's about $175 billion for calendar year of 2026, but they did mention for fiscal year of 2027, they expect capex to be higher on the year-over-year growth compared to fiscal year of 2026. So you can really easily read between the lines. If calendar year is not changing in capex, that mentions that any type of growth rate in capex is expected to come out in the first and second quarter of calendar year of 2027. Now, Microsoft stock is up 7.6%. I believe one of the reasons for it is they did mention free cash flow is going to remain positive, right? This is a kind of a little bit different from at least what Google showcased. Meta obviously was kind of flat on free cash flow. I think they were like about $700 million in free cash flow this quarter. Young Thug, what do you mean? What does that mean? So calendar year of 2026, their capex has not changed. Fiscal year of 2027, their capex is expected to be up year over year. So if fiscal year of 2027 implies that there's 2 quarters in calendar year of 2026 and 2 all right, I mean, everybody has a story, I see. But overall, I mean, earnings, I think, were good. Microsoft mentioned the compute demand. There's still more demand than supply. Azure grew 43%. But yeah, I think that's it for the stream. Neil had to leave. Tomorrow, we will be joining Amit and Tanner. We're going to be doing Amazon, and I forget who else goes tomorrow. So we will be doing a live stream there. I will be doing a recap for those that are curious on my channel. I think Neil, hopefully, maybe after everything goes well with him and his exam, will most likely be doing a recap video as well. So make sure to stay tuned to both channels. Take care. Have a good day, and see you all next time.